the equity market can move higher. But obviously, people are worried about more of a melt-up in rates.
Rates are the things that pressure equities.
A lot of uncertainty with regards to what's happening in terms of bond yields.
Fiscal deficit, inflation issue that's not solved, all of that is in the mix and it's pushing up yields.
I think the bond market here is pricing in the worst case scenario for what the upcoming administration could or might do.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. What a choppy start to 2025 as we come into Thursday after squeezing out a small day of gains on the S&P 500 yesterday. Equity futures shaping up as follows. This morning we look like this. Equities down by 0.1%. On the Nasdaq 100, we're down by 0.16. On a Russell, we're little changed. The fireworks in the bond market, not just stateside, but worldwide. Check out the UK, the 10-year, the highest since 08. The 30-year, the highest since 98. We've said this so many times on this program. Bond yields can rise for a lot of different reasons, but when yields are up and the currency is down, it's usually not good.
It usually represents something more likely seen in an emerging market. And this is the point that Jordan Rochester put out there this morning when he was basically saying, can we say that the United Kingdom is acting like an emerging market right now? Can we say that maybe the Liz Truss moment was not a moment? And maybe this was a reflection of this country losing some of its reputation on the global debt stage?
I'm pleased you brought up the Rochester note over at Mizuho. He offered 3 options to get out of this in the UK. 1, luck from abroad. We talked about that yesterday. 2, maybe the Bank of England can end QT. Or 3, tighten up your spending plans, do something on the fiscal side.
This is the problem. Ultimately, it's all going to come down to, can you effectively have an efficient government where you cut profligate spending without raising taxes in a punitive way that actually discourages job creation, which is what a lot of people are saying is happening in the United Kingdom? The answer is we haven't seen it. And good luck. And let's see what happens. And that's the difficulty right now. And that's the reason why people have one eye on what's going on in Washington, D.C. And can they get that house in order with something close to efficiency?
Well, let's keep it here in America then. Let's talk about the bond market stateside. We're putting a lid on a 4-day sell-off in the US bond market. Yields are lower by 2 basis points, 466.89. Helped up yesterday by a downside surprise on ADP and a more dovish than expected Governor Waller. But check out those minutes. Is this Federal Reserve, or at least parts of it, getting a little bit political?
Well, so maybe a number might be. I mean, that was basically, if you were looking for clarity from the meeting minutes of the FOMC about how many, you got a number. That's your clarity about the number of people who took into account potentially tariffs and other policy changes. Others said that they did not. And this all goes to show that essentially it's a black box, and we have even less of an understanding of what the scenario analysis is at the Federal Reserve. Aside from basically individual speakers, we're going to get a whole host of them today, really giving their sense of, it wasn't me, guys. I wasn't the one putting that assumption.
Who are they? I think this is really important.
That's true.
Who are they, and did they do the same thing in 21 when this sitting president came out with massive spending plans and pushed them through a supply-constrained economy? If they didn't do the same thing, why didn't they? And that will keep the door wide open to accusations of political bias.
Pretty much everything right now is going to leave the door wide open to political bias. You talk about Chris Waller and the fact that he came out and said that basically tariffs he doesn't see as an inflationary impulse. Immediately, all the notes came in just as you basically had your knee-jerk reaction of, oh, is he running for Fed chair? There was some dampening of that in a news report of Bloomberg saying actually he's being taken out of the running because of the half-point rate cut last year. Putting all of this aside, the fact that this is on the table shows how politicized this Fed is getting, whether or not they actually are politically motivated in terms of how their moves are interpreted and the lack of understanding of exactly how the Fed is really analyzing the incoming information and the potential policies coming down the pike.
Stay tuned for more coverage on this. I just want to get into today's schedule just briefly. Anne-Marie's down in Washington, D.C., of course, marking a special important occasion in the nation's capital, observing a day of mourning. The funeral of the late President Jimmy Carter. That will have implications for markets here in the United States, so allow me to go through some times. Equity futures are open, but they will close early at 9:30 a.m. Eastern Time. The equity market, the cash equity market, will not open today, so that will not open at 9:30. For the bond market, cash treasuries are open. They will close, Lisa, at 2 p.m. Eastern Time.
Yeah, with futures, I believe, closing at 1 p.m., which really just puts all the more emphasis on the bond market, which frankly has been one of the main drivers of a lot of the concern that's really rising in equity markets. I want to bring this to you, and this I think is really important. The fact that equity markets have held in as well as they have in the face of some of the bond market sell-off highlights how much they are dependent on growth, and a downside surprise could potentially derail that. This, according to Christian Muller-Glisman of the Goldman Sachs.
Futures on the S&P negative by 0.2%. Your lineup for the next 60 minutes looks like this. We'll catch up with George Goncalves of MUFG on the global bond market sell-off. We'll speak to Tobin of Wolfe Research as Trump visits Capitol Hill, and Nela Richardson of ADP looking ahead to payrolls. We begin this hour with the US bond market stabilising after a 4-day sell-off. George Goncalves of MUFG looking for higher yields over the next year or so. A hawkish Fed, fiscal policy uncertainty, and more supply should keep 10-year yields higher in 25. George joins us now for more. George, welcome to the programme, sir. It is not just America, it is global. What do you make of the backup worldwide in bond yields?
Look, I think the earlier comments you guys all mentioned and the quotes that DM markets are acting very much EM-like, and I think that's a real consideration. And this is just, I think, par for the course. We're going to, the further we keep having these debt loads, higher interest cost servicing, all this stuff is negative, and it's a negative feedback loop. And until we actually do get our fiscal house in order, I don't see these things ending.
In America, though, George, at least we've got robust growth. Yields are higher off the back of a better economy. People think we're spending too much. OK. In Europe, it feels different, George. It looks like they've got a dire growth backdrop, but yields are up and people also think they're spending too much. How do they get out of that mess?
Yeah, look, Europe has its own set of issues that are going to be much harder to kind of get through. And, with the lack of growth and just really, a vision and a plan of how to actually, motivate innovation and actual productivity. I mean, I think that's really what's lacking. I mean, the U.S. has benefited, yes, from growth, a lot of it coming from government spending. We can't deny that fact. But productivity and just, we are the kind of the fountain of all this technological advancement. I think that, really, creates like a stagflationary environment in Europe and the UK.
How much, George, is this really stemming directly from the United States? Essentially, the U.S. catches a cold, the rest of the world catches a flu, and that's going to be the way that this really develops, even if the U.S. is the source of the profligate spending and the profligate borrowing.
Yeah, and that's a great point because, it is that whole negative feedback loop. And, one of the biggest pushbacks that we've had that rates don't matter, and obviously they do because, it takes time, but eventually they exert their force in different ways. And the one that's really been the most dominant has been through the dollar, right? I mean, it's ironically enough, although there's elements of we're acting as EM like in the way we're spending, but the dollar has benefited, the EM currencies have not benefited, and and the rest of DM has been suffering. So the dollar move and the rate move in the U.S. Combined really does start to kind of cause issues for all markets going forward.
George, something that you said I want to pick up and really tie this to what Christian Muller-Glisman over at Goldman Sachs said, which is essentially the U.S. has growth. And Europe doesn't. And that has been really the saving grace, even if it comes with government spending. That growth, the technological advancement, that's what's been saving United States markets. I'm just wondering how susceptible the U.S. equity market is to a downside surprise economically, whether it's a payrolls report tomorrow, whether it's something else that comes down the pike at a time where that's the one thing upholding the pillar. So even if you get a rally in the bond market on the heels of that, you could potentially get a sell-off. Do you agree with that type of scenario?
Actually, I do. And I think tomorrow actually poses a lot of risks. Is on the one hand, if NFP is strong, then the Fed's cuts really come out of the table, or at least get pushed back even further. The bond market will be kind of concerned there, so rates will go up, and that's going to be negative for equities. If it's a really weak number, equities are probably going to look up and say, hey, maybe the economy is not as strong as we thought it was. And I think that kind of growth shock, and given the concentration risk in the U.S., and given the fact that the U.S. markets are such a dominant player in global equity space, I mean, there's only three ways you can fix that U.S. outperformance. Either the rest of the world catches up, the U.S. goes sideways, and nothing ever goes sideways, or the U.S. goes down. And if you have a big enough financial conditions correction, it's been FCI through the wealth effect channel that's also been a big driver of U.S. growth. Let's not kid ourselves on that as well. So government spending, FCI shock, you can have a real kind of protracted pullback.
George, equity markets are still close to all-time highs. Credit spreads are very tight. Nominal growth is pretty decent in America. Haven't we established over the last 12 months that we can handle rates at these levels?
I think it's to be determined still. I think that, we've been fortunate because of all the inflows, overseas investments into the U.S. If any of that were to change, I mean, it's not as if we're going to really pay down our debt that quickly, or at least we reduce deficits that fast enough that we still need our foreign investors. And so I do think that if there's any sort of repatriation, if there's any sort of pullback on capital coming to the U.S. into equity space, I think that the jury's still out.
So get in the policy seat. You're in a risk management business, and you've got to figure out what is the biggest risk right now: holding too long or cutting too much too soon. What is it? Cutting too much too soon or holding too long?
I mean, on the fiscal side, or just kind of risk appetite
At the Federal Reserve.
Look, I think the risk is that the Fed deviates from a consistent message that they need to still be easing, not get into this kind of concerns about what the fiscal outlook might look like. They need to focus on delivering a consistent message, being methodical with their policy, and slow down to every other meeting cutting. And if things get better, they can stop in the future. But if they have a long pause, the risk is that they're going to actually make things worse.
How much does the fact that we're questioning the political independence, not necessarily with the idea that Donald Trump is calling them up and saying, guys, cut rates, more the idea that people are jockeying to be selected to be the next Fed chair. Some people are saying, actually, this is an irresponsible policy. We want to push back against it. Whatever it may be, the fact that that's in the zeitgeist of the market, does that potentially introduce more volatility? Does this undermine some of the Fed messaging? Or is just this basically the way it always has been? It's just basically being highlighted more now?
I think the focus is much more hypersensitive now, but I do think that, like you mentioned, like the minutes from yesterday, and that meeting was like the most hawkish meeting in quite some time. Even though they still cut rates, there's a number of folks that really don't want to see rates heading lower, and you have that that faction. And then if you think about what is the right prescribed policy prescription, they should still be cutting, and so it kind of puts them in a tough spot. But nonetheless, I mean they need to. Take into account that the U.S. government needs low rates too. I mean, this is all very circular and interdependent. I mean, the U.S. Treasury market and the Fed, in many ways, are linked at the hip through the interest rate channel, and I think that matters. And so, if you ignore that for too long, eventually the risk is that you have to do YCC or you have to do something more dramatic, right? So I think that you can't divorce those two.
You talk in your notes recently, George, about the lack of conviction in markets and how it's basically going to be treading water until we get some sense of some clarity on what policies are going to look like from President-elect Donald Trump and his administration. What policies in particular are you looking for that really turn the tide one way or another?
Look, so it really comes down to as we all have been saying, sequencing, implementation risks, the unintended consequences. What are the priorities? What are done first? I mean, a lot of the market's euphoria. And let's not forget, like the stock market's up, but it's actually flat to the election. I mean, actually, it's a little bit lower if you look at the S&P 500. We're basically to like October levels. So we had a big run. I think euphoria is present in a lot of other, high beta risk assets. But in general, stocks haven't gone anywhere, right? They've kind of gone sideways after all the euphoria. So I think that's going to come down to we've got a lot of good news priced in, or a lot of animal spirits kind of trying to get embedded. I think it's going to be the tariffs, like how aggressive, how fast is that initially put in, immigration policy, and then how do you get your fiscal house in order? Like you need to start to address that. If you have a credible plan, the bond market will respect it and rates come back down. The Fed cut 100 bips and the market's up 100 bips. The bond market's sending a signal to DC like you have to get your fiscal house in order.
Hey, George, appreciate your opinion as always, sir. Thanks for the time. George Goncalves there of MUFG. Bond yield to lower this morning. Stateside, at least, we're down 2 basis points on a 10-year to 4.67. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. And we begin in Los Angeles, which is experiencing its worst natural disaster in decades. 5 fires are burning across the city, driven by hurricane-strength winds. At least 5 people were killed, and more than 100,000 residents were forced to flee their homes. There is an evacuation warning for major landmarks, including the TCL Chinese Theater and the Dolby Theater, where the Academy Awards are hosted, as well as parts of Hollywood Boulevard. The Biden administration is planning more AI chip export restrictions. Sources tell us that the regulations would create 3 tiers of chip curbs. A small number of allies would have unmitigated access to chips. A group of adversaries would be basically blocked from importing. The majority of the world, meanwhile, would face limits. The regulations could be issued as soon as Friday. And it's the National Day of Mourning in the United States for the late President Jimmy Carter, who died on December 29th at 100 years of age. A state funeral for Carter starts at 10 a.m. Eastern at the Washington National Cathedral. President Joe Biden is expected to deliver a eulogy. Carter was a former Georgia peanut farmer who served one term as president. He was notable for his post-presidency humanitarian work, especially with Habitat for Humanity. That's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Truly shocking pictures coming out of Los Angeles. We'll bring you updates throughout this morning. Up next on the program, unified behind Trump.
Whether it's one bill or two bill, it's going to get done one way or the other. I think there's a lot of talk about two, and there's a lot of talk about one, but it doesn't matter. The end result is the same.
We'll head down to Washington, D.C. and catch up with Anne-Marie in just a moment, live from New York City this morning. Good morning. Just a touch softer this morning. We're down by close to 0.2% on the S&P 500. Some stability in the US bond market. Yields are down by close to 2 basis points now. The 10-year 467.29. Under surveillance this morning, unified behind Trump.
Whether it's one bill or two bill, it's going to get done one way or the other. I think there's a lot of talk about two, and there's a lot of talk about one, but it doesn't matter. The end result is the same. We're going to get something done that's going to be reducing taxes and creating a lot of jobs and all of the other things that you know about. But this was a really unified meeting.
So here's the latest this morning. Donald Trump praising a unified meeting with Senate Republicans on Capitol Hill, discussing his priorities. But Republicans in the House and Senate are still divided over how to get his agenda through. Anne-Marie joins us now from the nation's capital for more. AMH, good to see you down in Washington, D.C. once again. You tell us, are you seeing or hearing any details on this front? We get that they're saying they're all on the same page. Do we know about size, sequencing, process, how quickly, the timeline? Do we know anything?
Well, whatever you're hearing about the fact that they can't even decide on the sequencing, wait to hear about the size of this and the top line budget. Can you imagine the debate that is going to go on? I think what you see reflected right now amongst the debate right now, and I was on Capitol Hill yesterday speaking to some representatives about how they see and differ on this approach. I think you have to remember is that this is going to be very challenging, whether it's one big, beautiful bill or two-track approach. They have very slim majorities, more so in the House of Representatives. And remember, in the House, they also need to make sure they fill seats. Representative Matt Gaetz' seat, Mike Waltz, that is going to be Trump's national security advisor, and Elise Stefanik. They need to fill those seats to make sure that they have enough votes to get this bill through. Before they even start talking about how big it is, they need to decide on the sequencing. Or maybe the entire debate will play out open. The fact of the matter is, we don't know. And if you were looking for clarity, we did not get that yesterday, except for the fact that Trump has made clear he doesn't really care as much about the procedure. He's not there counting votes. And frankly, that's not his job. But he does care about his agenda. Whether it's one bill or two, he wants to get that agenda through. But this line stuck out to me. After meeting with House Speaker Mike Johnson, Senate Majority Leader John Thune said this, joking with reporters, that the plan for sequencing the legislation is as clear as mud. And I expect that at least for the next few days, maybe weeks.
They're at least attempting to hit the ground running. Anne-Marie, appreciate it. More from AMH in the next 10 minutes or so. Tobin Marcus of Wolfe Research joins us now. Tobin, Speaker Johnson has talked about passing one big, powerful, beautiful bill and getting it out of the House by April. How big is that bill going to be, Tobin?
I think in terms of gross numbers, how it would be scored by the Congressional Budget Office, we're looking for something in the mid $4 trillion range. But of course, the gross size of the bill depends a lot on, the length of the extensions of various provisions. I think certainly there will be some timing gimmicks on some of the provisions to minimize the apparent cost. So it's going to be a big bill, and I think it's going to need to be at least partially paid for.
Tobin, how is it going to be paid for? We keep hearing this, that everyone's looking for cost cuts. Republican members come on the show and they say we care a lot about making sure that it is a balanced budget. And then we talk to analysts who say there is no feasible way to actually cut the deficit in any material way going forward. Is that your take on it as well, or are you seeing actual policies being put into effect or even discussed?
So I certainly agree that we're not going to be able to materially cut the deficit. I think our base case, even in a bill that does incorporate some meaningful offsets, is that the deficit to GDP ratio is going to remain in the 6% range or higher for the foreseeable future. So, the idea of balancing the budget, we're a long, long way from that. That being said, I think the one big beautiful bill strategy reflects the fact that the House is probably the sticking point here more so than the Senate. And I think House conservatives are going to demand, some tough choices to partially offset the cost of that bill. So, we're looking at partial rollback of the Inflation Reduction Act's clean energy tax credits. We're looking at possible long-term reforms to Medicaid. I think there are some realistic policies that could bring that number down that I think are going to end up being in the mix.
We've heard mixed things, Tobin, about how much this Congress is going to be looking at the bond market. Do you have a sense of what kind of check markets are going to be on some of these proposals, getting them on board with potentially a greater degree of cost cutting?
I think we probably need to see yields get materially higher before that starts to be a huge driver of the conversation in D.C. I mean, D.C. tends to be a little bit insular. The debates about the budget math are much more about the sort of 10-year scoring conventions and so forth than they are people, watching day by day movements in the 10-year. But, if yields push above 5%, I think that changes the conversation in a very significant way. The difference between 4.4 and 4.6, I don't know that really moves the conversation much.
Tobin, when we speak to Republican lawmakers, they talk about being responsible, aware, sensitive to what could develop in the bond market. But when you ask what they can do to offset some of the spending, you don't get much detail. What can DOGE do to counter all of this spending? What kind of numbers are you thinking about on that front?
So I think it's less what DOGE can do. I don't think that much of the spending cuts are going to come on the discretionary side. I think that DOGE is very interested in looking at the ongoing operations of government and figuring out if they can squeeze waste out there in terms of year-by-year discretionary spending. But you can't really go after that in reconciliation. And so I think when we're thinking about reconciliation pay-fors, again, we're thinking about tax expenditures like the IRA credits. And when you look on the spending side, I think Medicaid really does stand out as the thing that offers itself up as a potential source of cuts. Like, they're not cutting Social Security and Medicare because Trump doesn't want to. The next big spending program, like mandatory spending program in terms of entitlements, is Medicaid. And I think they will look at that, even though they're not talking that much about it now. Because I don't think it's going to be that popular. I think it probably is politically survivable. We're hearing some noise, but I think that'll be heavily in the mix.
We're talking about so many different things. We're 11 days for inauguration, and we're already herding cats. Panama, Greenland, when it comes to the Gulf of Mexico. Tobin, the list goes on. And I wonder what you're telling clients. Do you believe these are just negotiation tactics, or do you believe the incoming administration is really pursuing a forceful realignment of the global order?
Well, John, I believe you mean the Gulf of America. But, I think that it's floating sort of big ideas that appear outrageous to a lot of people is certainly in keeping with how Trump approached the first administration. I don't really think this is going to be what the administration is about. When it comes to Mexico, I think we have bigger things on the agenda for that bilateral relationship than the name of geographical features. Again, we have this 25% tariff threat out there. Immigration, I think, is probably going to be the biggest item in terms of day one executive orders, things that Trump does unilaterally the day he comes into office. And Mexican cooperation on enforcement is going to be a huge, big part of his potential for advocacy there.
Forgive me, the Gulf of America. I'll get there, Tobin. Tobin Marcus of Wolfe Research. Tobin, thank you, sir. Thank you very much. You on board with that, Gulf of America?
Did you see what Claudia Sheinbaum of Mexico, her response? She gave this press conference where she put a map on the wall, and it showed what the map looked like more than 100 years before the United States was created.
She wants to absorb some southern states.
And she said at the time, North America was viewed as America Mexicana, or Mexican America. And she said, that sounds nice, no?
We're going to see a lot of trolling, aren't we, over the next several months on this front. It's already started.
Well, this is the reason why people are overreacting, maybe, to this, why Denmark just says, not really, guys. And you have Canada saying there isn't a chance in hell that this is going to happen and become the 51st state. Question is, what is the distraction keeping people from paying attention to? And that, I think, is increasingly what people are going to be focused on. How do you look at the signal and not the noise?
I think you've got to respect the seriousness of the attempt to realign the global order when it comes to things like Greenland. I think they're fairly serious on that front. I don't think that's just trolling. I think they're pretty serious on that front.
You think that they're going to take military action against Denmark?
No, I'm not going that far.
Maybe tariffs?
I'm just saying that there is a serious focus on that part of the world for geostrategic reasons, and that focus is not going away.
I would agree with that, and I think that some people would argue that because there's a pretty big military base there already from the United States and they have access to the rare earth minerals, they already have it. But you are correct. There is a real focus here.
Anne-Marie can answer all these questions. We'll head back down to D.C. in just a moment. She'll be speaking with the former senior U.S. intelligence official, Norman Rule, in just a moment. From New York, this is Bloomberg. of drama this morning on the equity side of things. We're down about 0.1% on the S&P. On the Nasdaq, we're down by 0.2. In the bond market, setting the tone for things worldwide, Treasuries settled down just a touch. Across the curve on a 2-year, 10-year, 30-year, yields are lower by a basis point or two. We're down a single basis point on a 10-year to 467.29. On a 30-year, 490, getting closer and closer to that 5% line in the sand. Jim Reed of Deutsche Bank had a great line in a note that he put out to start the week, that the 30-year in the US has only been above 5% for 6 trading days. 6 trading days, and that was back in October 23 since 2007. So it's been pretty rare over the last 2 decades or so to have yields at or close to these levels.
And yet here we are, and ultimately if we get there, there's a lot of guests who come on the show say that we will. Test to me will be whether it gets bought. And yesterday the signal from the bond market was that the 30-year got bought at these levels with a successful auction of $22 billion of notes. That was one thing that gave us support to this market. Does that continue as we get more details, particularly about the budget?
Let's pick out a market that's not getting much support. Let's look at what's happening with sterling right now. The pound is breaking down once again by 0.6%, 122.84. You can see this is playing out much more heavily for the sterling side of the trade compared to the euro, which is only softer by 0.2%. And this is happening even as the sell-off in gilts continues, up another 6 basis points on a 10-year. Lisa, approaching 490 for all the wrong reasons in the United Kingdom.
So yesterday, former Prime Minister Liz Truss sent a cease and desist letter to Sir Keir Starmer, saying that he needs to stop saying that she crashed the UK economy and saying that that is a libelous statement. And there is a real ultimate question here. Was it a Liz Truss moment, as we called what happened in 2022, and it was a much steeper sell-off in bonds and the pound, or was it a UK moment? This question of have they lost their clout on the global debt market stage, especially as they look to potentially increase taxes and cut spending in order to get a budget under control. And now it becomes maybe a Rachel Reeves moment, or maybe just again, this is a moment that the country cannot avoid.
Yes. I think it'll evoke memories of 2022, but I'm with you. Speed, magnitude, completely different back in the 22 occasion, that scenario. I mean, we also had the overlay of the pension issues as well, and it's very different this time around. But I think you're right. This is becoming a UK issue. They're losing fiscal space. When you see yields up and a currency down, that's a very EM emerging market type phenomenon. That's not something we're seeing play out here in America.
And Jordan Rochester made this point, and I think a lot of people are drawing parallels between the UK and the rest of the world. But there is a message here, and I think this is the reason why people keep bringing up the Liz Truss moment for the United States. And that is when interest rates start rising enough, that torpedoes your ability to balance your budget at home because that increases your base costs. And that is what the UK is facing, and that potentially...
It's a doom loop.
Yeah, exactly.
Just get worse and worse. You mentioned Jordan, top of the note. What was it? Great British Peso or something like that?
Yeah, then talking about other emerging markets. I'll pull it up to get it.
Brutal in the United Kingdom. Jordan, thanks for that. Under surveillance this morning, a serious story. Los Angeles facing its worst natural disaster in decades as firefighters struggle to contain 5 wildfires burning across the region. The fires leaving at least 5 people dead and forcing more than 100,000 residents to flee, with hurricane-strength winds expected to last through Thursday. Just brutal images coming out of that region.
The most devastating fire in the region, in LA, in history, potentially, at a time when there are real questions around, A, what could have been done to prevent this? B, how do you bring everyone to safety at a time where some people are saying, where was our plan? Why were we stuck in gridlock? And then a question going forward, how do you rebuild and ensure homes in areas that are prone to this type of fire, especially in a changing climate?
The blame game's already taking place. You're going to get the Democrats blaming Republicans for not taking climate change seriously. And I think the Republicans will make a very obvious counterpoint to that, which is you guys are in charge. Do something about forest management. Make sure you've got the water to begin with. I'm not sure the people who've lost their homes care. They want this fixed, and fixed pretty quickly.
They want it fixed when it comes to preventions going forward. They want it fixed when it comes to assurances that things can be done to mitigate this going forward. And they want assurance from their mayor that she's going to come back to the country and possibly come up with some sort of plan.
And not be in Ghana. Yeah, angry. I can imagine they are just angry, really angry with the leadership coming out of California and Los Angeles.
In the meantime, our hearts go out to them because this is just devastation. More than 100,000 people evacuated, watching their homes get destroyed without really being able to stop it.
We'll bring you updates throughout this morning. Certainly some bad news coming out of California, some good news potentially on the horizon elsewhere. US dock workers and their employers reaching a tentative labour deal. The new contract would avoid a shutdown of East and Gulf Coast ports next week if ratified. Bloomberg learning the agreement includes guaranteed union jobs when certain technologies are implemented and preserves the 62% pay raise agreed to back in October.
What's interesting to me is that this wasn't at the last minute. Normally, these kinds of deals happen right at the 10th hour, 12th hour, right before January 15th, when it was sort of set in stone. I wonder if this is a sign of a realization that you kind of have to take what you can get, and that the world is changing faster than maybe you can demand certain provisions to stay up to speed.
But if there are some people with some leverage, I would say it's the union workers at the docks right now. I think they've got some leverage, but I'm with you. The broader story, I think that the labour market and the employees are losing leverage to the employers. And we've seen that. I think we talked about it yesterday with JP Morgan, reportedly asking people to come back 5 days a week. Not typically what you'd see when the labour market is super, super tight.
Yeah, I wonder if this is sort of the beginning of an ongoing slew of union negotiations, or something you've mentioned in the past, sort of the last gasp before a different change that we have in the market.
Yeah, without a doubt. Let's turn to this story. I want to squeeze this in. The latest Fed minutes showing the central bank is looking to slow interest rate cuts in the months ahead. Officials citing higher inflation readings and strength in consumer spending. Fed officials also using placeholder assumptions for possible policy changes under the incoming Trump administration. When we closed out the show just yesterday, I said we're looking for a number. How many people? And I literally said a number.
Yeah.
How many people? And then they just wrote a number. Lisa, you said this too. I mean, super helpful yesterday in the Federal Reserve minutes.
You said we're looking for a number. They gave it to you. A number.
Yeah.
And that's basically what we're going to be stuck with. I do just wonder, they're kind of stuck between a rock and a hard place, in fairness. If they don't take into account any of the policies coming down the pike, that could be potentially irresponsible. If they do, that also could be potentially irresponsible if they make assumptions that could be viewed politically. How much is it sort of saying the quiet part out loud, that they are kind of considering what the market is considering, and that is going to be proven to be sort of a bad calculation?
It's basically what they're telling us. And if they're between a rock and a hard place, they put themselves there. They're victims of their own communication apparatus. And if they don't like them, they can change them, can't they?
What would that be? Just to stay quiet?
Staff forecast, get rid of the dot plot, all of the above. We talked about this in the last couple of weeks.
Are you running?
Am I running?
Yes.
To be the Fed chair?
Yeah.
Nobody wants that. Let's turn to the Middle East. The Israeli military saying it has found the body of a hostage in Gaza, possibly alongside his son's remains. The discovery comes as Donald Trump's incoming team hopes to secure a ceasefire and hostage deal between Israel and Hamas ahead of his inauguration on January 20th. Let's head down to Washington, D.C., where Anne-Marie is sitting down with the former senior U.S. intelligence official, Norman Rule. Hey, Anne-Marie.
Hey, John, thanks so much. Yeah, what we're hearing right now from the incoming Trump administration, from Steve Witkoff, who went over to Doha to be a part and witness these negotiations and to really lend some support, is that they think that they can have good news to deliver. So, of course, we want to bring in Norm Rule, who spent decades at the CIA dealing with Middle East and conflicts. Norm, is it your understanding that potentially we could get a Gaza hostage agreement before President Biden leaves office?
Good morning. Yes, that is correct. The incoming Trump administration and outgoing Biden administration have been working very closely with no reports of any disagreements or frictions to achieve this. The statements by President Trump beginning in December that there would be all hell to pay if the hostages were not released, injected new life into this issue. And both Hamas and the Israelis have claimed that they have made concessions to make this hostage deal, which would be the first phase of a longer deal, happen. This said, the phrase cautious optimism has been used repeatedly in the past. Hamas has not dropped its primary demand, which is that Israel end the war and withdraw. Israel has not dropped its primary demand, which is Hamas cannot be allowed to regain control over Gaza. So the exit strategy for this conflict continues to be tied to this hostage deal.
Norm, I'm in Washington, D.C. today because of the funeral of President Jimmy Carter. And like Jimmy Carter, President Biden, on his final days of office, is working to secure Americans abroad. Now, obviously, these hostages, I'm talking about the Iranian hostage crisis that Carter dealt with, the conflict, the crisis, very different in nature. But all roads lead back to Iran. Given your work and decades of experience dealing with Iran, what has changed from Jimmy Carter's presidency to now?
In some ways, the modus operandi of Iran and its proxies and hostage-taking remains identical. And in fact, there's another echo from 1979. During the Carter administration, the Algerians played a prominent role in engaging with the Iranians. Today, we have the Qatari government playing its large role in dealing with Hamas itself and sometimes the Iranians. So you do have strange echoes of this period. But since 1979, not only the Carter administration, but the Reagan administration in Lebanon and the United States repeatedly with Iran have dealt with a drumbeat of hostage-taking by Iran and its proxies. And these events tend to be multi-month, multi-year in many cases, where in the end, significant financial or political concessions are required to release hostages. Iran and its proxies have very little care for human life and dignity, but focus on their own interests.
Many observers would point to the peace agreement between Egypt and Israel that Carter was able to get over the finish line. How do you see that shaping the region?
It was dramatic and significant, but at the time it was not something that was a sure thing. The Carter administration entered office hoping to follow the steps of its predecessors, large international conferences involving the Soviet Union, the Geneva process. In fact, the Carter administration was not initially enthusiastic about Sadat's solo diplomatic engagement. The Washington Post at the time famously described the cool Carter reception as being so chilly it could freeze the Nile. But it did open for the first time the possibility of something that eventually, under the Trump administration, became the Abraham Accords. It's just things move slowly on these issues.
I'd love to end on that point because we do have an outgoing president who wanted to expand peace in the region, that Abraham Accords between Saudi Arabia and Israel. He wasn't able to finish it. And now we have an incoming Trump administration that certainly wants to make sure they're able to get that over the finish line. Do you see that doable in the next 4 years?
Yes. And in fact, the Biden administration also built on the previous Trump administration's work to pull together a Gulf security agreement with an important agreement with the government of Bahrain. And this agreement with Bahrain, which is a bilateral security agreement with the United States, now also includes the United Kingdom and is open to other partners. I think what we're going to see is perhaps not an expansion of the Abraham Accords, although that is possible. We may see economic integration. We may see greater an expansion of the Bahrain agreement. We may see a variety of different architectures. But if a two-state process can be established, I think it's inevitable that you're going to see this integration of the region, which would mean an expansion of the Abraham Accords and the peace process.
Norm, thank you so much. Jonathan, that was, of course, Norman Rule, a former U.S. intelligence official. One thing is very clear to me. This Iranian hostage crisis that engulfed the final year of Carter's administration, when you talk to people like Norm, not much has changed about Tehran and the Iranian regime.
He is one of the very best. Anne-Marie, appreciate your time. Look out for AMH a little bit later this morning. In about an hour from now, catching up with the former Speaker of the House, Kevin McCarthy. That will take place at about 7:45 Eastern Time. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. At least 5 massive wildfires are burning across Los Angeles. President Joe Biden has canceled a trip to Italy instead to focus on the federal response to the fires. And during a meeting in Germany, Defense Secretary Lloyd Austin said the Pentagon is ready to provide aircrafts to help extinguish the flames from the sky. Mexico's President Claudia Sheinbaum has countered President-elect Donald Trump's proposal to rename the Gulf of Mexico with a suggestion of her own. Sheinbaum said that large parts of the U.S. should be renamed Mexican America, saying the name has a nice sound to it. She noted that a large part of the western U.S., including Texas and California, had previously belonged to Mexico. Former Google CEO Eric Schmidt has invested in 3D printed rocket maker Relativity Space. Sources told us that Schmidt has been backing the company since last year, helping it overcome fundraising challenges. The company is developing the Terran R rocket that is set to launch in 2026. It received a $4.2 billion valuation back in 2021. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, counting you down to payrolls.
What we're seeing is a frozen labor market, one in which we're not seeing much hiring, we're not seeing much quitting. A frozen labor market is unstable. Policy direction over the course of the next few months is going to be key in determining which side of the ledger the employment market falls.
That conversation up next, live from New York. You're watching Bloomberg TV. Stocks at the moment just a little bit softer. We're down by 0.2%. Check out the bond market, though. Back on September 18th, your 10-year yield, 364. Why September 18th? Because that is the same day that Chairman Powell cut interest rates 50 basis points. And since then, Elisa, yields are higher by more than 100 basis points.
And it has been relentless, and it has been an escalating move starting at the last month of last year. And this raises the question of how much is tied to policy, how much is tied to debt exhaustion, and how much is tied to an economy that really is showing inflationary pressures.
The next stop is the economic data under surveillance this morning. We're counting you down to payrolls.
What we're seeing is a frozen labor market, one in which we're not seeing much hiring, we're not seeing much quitting. A frozen labor market is unstable because we could either see a further deterioration in labor market growth, or we could see a resumption of stronger confidence. Policy direction over the course of the next few months is going to be key in determining which side of the ledger the employment market falls.
So here's the latest this morning. Traders bracing for tomorrow's payrolls report. The median estimate in our survey calling for 165,000 jobs added and unemployment to stay flat. Nela Richardson of ADP predicting a slowdown, writing the labour market downshifted to a more modest pace of growth in the final month of 24, with a slowdown in both hiring and pay gains. I'm pleased to say that Nela joins us now for more. Nela, good to see you. Happy New Year.
Happy New Year. Good to see you.
You put out your numbers yesterday.
That's right.
Where did you see weakness and where did you see some strength?
Well, we saw weakness in manufacturing, and this is, doubling down on a trend we've been seeing all year. 3 consecutive months of shedding jobs in manufacturing. That's very cyclical. On the strength side, we have to turn to a very non-cyclical sector, which is healthcare. Healthcare has been posting strong gains for the last 6 months. You see that in the ADP data. You also see that in the BLS data. It's what's really driving the jobs market now. And the question is it enough for 2025 for healthcare to be in the dominant position?
Are workers losing leverage against that backdrop? If you're seeing more narrow gains, if we're losing breadth and it's coming from areas outside of cyclical sectors in the economy, are we seeing a loss of leverage for workers more broadly? We've been talking about this over the past few days. JP Morgan saying, get back to work, get back to the office 5 days a week. We talked about it a little bit earlier this morning, that maybe that's why the unions on the docks are maybe settling a little bit earlier. What are you seeing around pay and signs of a loss of leverage?
We're seeing a lot, and I would align with those remarks that workers have lost some leverage from the heyday of the Great Resignation when they were clearly in the driver's seat. There is no one in the driver's seat right now. I think in the labor market, it's pretty calm and quiet. But what we're seeing is that pay growth has declined. We're looking at the lowest pay growth for job stayers since 2021. So that is significant. But also you have to look at hours worked, and that's where companies are kind of fine-tuning their labor count. Layoffs are very low. They're at historical lows for the past 2 years, but the number of hours people are working have been declining consistently over the past year and a half. That means that workers are making less. Also, I'll point to the JOLTS data that came out this week. Everyone made a big hubbub about the job openings. I went directly to the job quits, which are much lower. So people are staying put in their jobs, and that means there's been very little turnover in this labor market.
I agree with you. 1.9%, which is tied with the lowest rate for quits going back to 2020, and really raises some eyebrows about just how much mobility an agency workers feel. I am wondering the why. behind this? Is it because of policy uncertainty from companies? Is it because borrowing costs are higher and they're not making big expansionary moves? Or is it because they're still watching what's going on the artificial intelligence front with the potential that this will make some big changes to their workforce and they're not sure exactly how?
So let's take those pieces together. I think there is a bit of uncertainty about policies, but when you look at where the weakness is in terms of firm size, it's really been in small firms that we've seen the slowdown in hiring. Big firms are still hiring. And you see that clearly in the ADP data. So that points to more financing constraints than it does to AI investment or uncertainty about what, the next tariff policy will be. Most small firms don't operate in that macro scenario on a consistent basis when adding 1 or 2 employees. So when you're looking at that, interest rates matter in terms of financing costs for small firms. Longer term, over 2025, I think that AI investment and those trade-offs between capital and labor become much more relevant starting this year, but also into the future.
Are you saying that on the ground, from the bottom up, what you're seeing is that long and variable lags still do exist and that they just got a lot longer and that they still are restricting certain smaller companies?
They've gotten a lot more variable. Our lags.
Okay. All right. So they've gotten a lot more variable, and that's the reason why you are seeing it only in smaller businesses. But are you saying that rates staying here might look like they're not necessarily hampering financial conditions, but they are constraining the labor market in a more significant degree at this point than they did even 6 months ago?
Firms that rely on bank capital and small business loans are feeling the effects of higher interest rates. It may not be translating to the larger firms yet, but in terms of on the ground, the mom and pop, the Main Street businesses, I think you see that in their hiring decisions. And so, yes, that is material because small firms are the engine of growth for the labor market and for the economy. And if you want that dynamism to continue, it really has to be at the small firm level.
So, Nela, what's your reaction to the recent shift over at the Federal Reserve? What do you make of things?
The recent, well, there's been a couple shifts. I think what we're seeing in terms of the commentary around the Fed is that they have put out this idea of being more patient. And this is a Fed that we're not really used to seeing historically. Usually the Fed, when it's starting a policy change, it's moderate, predictable, modest moves every decision meeting. Now we're seeing a Fed that says, hey, we might take a break. We might, go on vacation for this one and do a rate cut at the next meeting. And I think that adds a little uncertainty to what the future path of interest rates will be.
And some of us might include some changes to policy that we might expect, and some of us might not. And that's been part of the confusion as well, Lisa, over the past month or so.
How does a market factor in what the Fed is going to be looking at when we don't have a sense of what policies and input data will potentially be going into their equation? It makes it rather confusing.
Does that make it more confusing for you, Nela?
For me, it's about the data. Right? Some of this is just kind of animal spirits. It matters for the markets. It matters for the mood of making investment decisions. But does it matter for that HR director in a company who's trying to figure out how to grow a business in a particular area? Those policy changes are not going to hit that HR director in this month. It might play out over 6 months or a year, but they have to figure out the here and now in terms of the economic conditions that they're confronting with their customers, not what the Fed is doing.
It's increasingly complex, that's for sure. Nela, it's good to see you, as always. Thanks for dropping by. Nela Richardson there of ADP. Up next on the programme, we'll catch up with Jim Zelter of Apollo. Do not miss that. Jim in the building for 30 minutes. That kicks off in about 5 minutes from now. Then we'll speak to Alex DaSilva of AccuWeather and the former House Speaker, Kevin McCarthy, catching up with Anne-Marie down in Washington, D.C. I think we've all got the question on top of our minds, Lisa, which is how big is that bill going to be and how quickly can you pass it?
And how much offsets are there? How many offsets to the potential deficit increase that a lot of people are expecting?
That's just around the corner, the second hour of Bloomberg Surveillance. Up next with equity futures on the S&P, just a little bit softer.
You want to stick with the primary outperformance of the U.S., which we expect to continue.
If earnings are in double digits, we should have a positive year this year in the S&P.
We think the first half is going to be choppy. The second half of the year could be much, much better for equities.
We actually think that you are going to get the broadening this year. The deregulation backdrop that we're about to have in the incoming administration is profound.
These policies do matter quite a bit. That's why the market is moving so much on each of these headlines and will continue to move.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It's one of those mornings. It's that time of the year where you sort of wake up and the first thing you look at is the gilt market. Waking up in New York City. You look at UK government bonds, apparently. Yields are up by a couple of basis points again, up by 3 in the UK. Levels we haven't seen since 2008 on a 10-year, 1998 on a 30-year. The 30-year this morning up by another 2 basis points. They've got problems over in the United Kingdom, not just of their own making. They've got problems from all over the world.
You mentioned Jordan Rochester earlier and how he's talking about how much UK is rhyming with an EM country in terms of the response in its debt market, its currency market. And you said something about the Great British Peso, which was his first thing that he said, and then Istanbul-on-Thames was the other one. And basically, this is sort of the sentiment right now. Have we broken the normal connection with developed markets and their ability to finance their deficits through the bond market?
We mentioned this in a previous hour. One thing that Jordan mentioned, really, to address the problems in the UK could come externally, at least one. They'd be praying for worse data out of the United States of America and a downside surprise on payrolls tomorrow morning. The estimate in our survey for payrolls tomorrow morning, 165, the previous number 227. You get a number north of 200K, you've got even bigger problems abroad.
This goes to the crux of the existential issue that's facing the rest of the world. The U.S. gets a cold, the rest of the world catches a flu, and it's even more relevant when the U.S. has a deficit that is the highest it has ever been on an absolute basis. When you talk about the fact that it is starting to be reflected in the bond market and it's being carried over into other economies that are much weaker, that are not seeing the same growth. What happens if the U.S. has the same deficit, same yields, but not the growth? And that is the fear that a lot of people have.
We live in a tripolar world, and if you go through each of every one of the 3 regions right now, it's really a different backdrop. In the United States, growth is good, yields are up, and people think we're spending too much. In China, growth isn't great, yields are down, and people think the government isn't spending enough. And in Europe, they're stuck in between, getting the worst of all worlds. Growth is bad, yields are up, and people think they're spending too much. What do you do with that?
Well, you try to get a leader first, which is part of the problem because there isn't really a great deal of leadership in Europe. But this is the reason why, even though the prospect of ECB rate cuts is much greater than, say, Fed rate cuts, people aren't flocking to the sovereign debt market in Europe because the backdrop is so uncertain and they are stuck between the 2 poles that really are whipsawing them in different directions.
Anne-Marie not around the table with us this morning. You might have noticed Anne-Marie's down in Washington, D.C. to observe a day of mourning for the late President Jimmy Carter, the funeral taking place later on this morning. That will have implications for financial markets here in the United States. Just allow me to go through some times for you if you are just joining us. At 9:30 Eastern Time, equity futures will close. The cash equity market will not open today. For bonds, cash bonds, the Treasury market will close at 2 p.m. Eastern Time. So just some names, some numbers, some times to keep in mind a little bit later on this morning and into this afternoon. The next 60 minutes is going to shape up as follows. I can go through the timeline of events for you. In just a moment, we'll catch up with Jim Zelter of Apollo Asset Management on the outlook for private credit. Later on at about 7:30 Eastern Time, we'll speak to Alex DaSilva of AccuWeather as devastating wildfires continue to threaten Los Angeles. And then Anne-Marie catching up with the former House Speaker Kevin McCarthy on President-elect Donald Trump's agenda. Do not miss that in just a moment. We begin this hour with stocks inching lower. Jim Zelter and the team over at Apollo Asset Management looking for opportunity outside of equities, saying, quote, if interest rates remain higher, as we expect, and the terminal Fed funds rate stays higher than where it has been historically, we see private credit as an attractive alternative to overvalued public equities. Jim joins us now for more. Jim, good morning and a very happy new year to you.
Good morning, Jonathan.
I'm going to kick off this conversation by stealing one of Lisa's questions to start 2025. Are stocks too rich or are bonds too cheap?
Well, I think we have a backdrop. I think your point about the U.S. and China and Europe and the 3 parties, it's our view that and Torsten has been very consistent. The U.S. economy has been the beacon of opportunity in the last several years. Strong economic growth, capital coming in from around the globe. And so in terms of, I don't want to talk about the stock market, I'd rather talk about the underlying economy.
Sure.
Underlying economy looks like it's the place to invest. I don't think it's any surprise that when you peel the onion back, private capital, which has really been embraced in the U.S. and gives diversity of funding, lets companies grow, start, expand, and all the things we're talking about, the global renaissance, it's been the place to invest and it's been attracting capital. Contrast that to what's going on in the UK and continental Europe, where they are stuck in a financing system that's really 15, 20, 30 years behind the rest of what's going on in North America. It tells us that the U.S. is the place to invest.
So you think some of these problems in Europe might be more structural in nature?
I think structural is really the key to really analysis. It's very easy to focus on the last 3 to 6 months. We talk about the Liz Truss moment in the UK. I think it is a great reminder for this current administration, as they've got great ambitions in terms of U.S. investment, CapEx, tariffs, immigration, a variety of other big initiatives. It's good for this reminder of the Liz Truss moment in the back of their minds to know what can happen if you lose confidence. But there's no doubt, I think, if you look at what the Draghi document did, later last fall, he pointed out in 158 summary pages of all the challenges that they have not really embraced. And while the banks are in better shape than they've been in a couple of decades in Europe, the U.S. is the standout. We have the greatest financial services sector in the world. We have the deepest, broadest capital markets. We've undergone a tremendous amount of regulations on our banks, and they've continued to thrive in a more narrow world. And that's the page that the Europeans should be looking at, embracing securitization, embracing private capital. They've got a massive amount of infrastructure needs, and they should be embracing that for their long-term economic success.
In the meantime, people are saying that maybe the ghost of Liz Truss is kind of hovering over this administration and hovering over the U.S. Treasury market right now, especially given the rise that we've seen in longer-term yields. And I'm wondering how susceptible you are to changing your view on how constructive the U.S. economy is if you get some more negative data prints. We had Greg Dako yesterday talking about a frozen job market. We had Nela Richardson talking about how smaller companies really are feeling rates where they are.
Rates have been higher for the last 12 to 18 months. They've been higher. Obviously, we're in a period right now where what the Fed did in its actions in the fall and what the market has responded to is a very unique period. So you're right. We are in a little bit of a unique zone here with regard to macro and rates in the U.S. I do think we are in a period where rates do look attractive versus where equities are. And we're in a period right now where we're still the place of economic growth, but it is a warning sign for the administration about how much they can push. Now, clearly, the other side of the trade, I would not probably be lowering rates right now. I think that you have full employment, economy's doing quite well. I'm not sure I see a need other than economic textbook to lower rates in terms of the target, but it does create a lot of room for the new administration if they have weakness in any kind of the economy because of their initiatives. The Fed put his back, they have a lot of room to move.
Your colleague is sort of edifying your points as you say them, Torsten Slok, moments ago. Inflation reaccelerating, to your point about not necessarily needing to lower rates further. You talk about credit being the sweet spot and debt, maybe even over equities. And that has been the story over a long period of time, this past couple of years. If inflation could be reaccelerating, could you see that story changing at a certain point?
Yes, you could, and I guess listen, there's a lot of consensus out there about where the S&P is going to go, where rates are going, but in our view, in the backdrop, the U.S. economy is still the strength of the globe. It's the beacon of economic opportunity. We still have a lot of economic growth in terms of the industrial renaissance that we've been talking about. So, in our view, the breadth of credit, investment grade as well as non-investment grade, we try to find areas of dislocation or areas of mismatch of capital and opportunity, and we're still seeing it in credit versus the equity markets. Now, when you look at the S&P 500, I would say that it's interesting. We all know what the Magnificent Seven are, but certainly the other 493, a lot of unloved opportunities in that basket. And there's probably an opportunity in a non-consensus view in terms of those companies, in terms of just pure economic growth. But we are still, listen, private credit and private capital has been the engine of economic growth in the U.S. And I will, again, I said earlier, it's not a great irony. It's a great irony that the U.S. has been the bastion of economic growth with the embracing of private capital. But, one of the greatest investors in U.S. capital history, Warren Buffett and Berkshire, when you really pull the covers back on Berkshire Hathaway, of the $1 trillion of assets at the end of 23, 30% are in the public equities that we know about, Apple, Coca-Cola, American Express, B of A. But 70% are private companies. It's the growth engine. He's the greatest capitalist. He's been doing it for 50 years. That's where growth and opportunity is in America. Private capital in private companies. And they have access in the debt markets. They don't need to go public to raise capital anymore. 8,000 public companies to 4,000. That's the trend in the future. And we're sitting really at an intersection trying to bring those opportunities to the broad group of investors, retirees, and savers around the globe.
So you mentioned Europe, and Europe, certainly, the bank channel is overburdened. We've been talking about this for years, the Europeans have. Draghi talked about trying to do something with public markets in the same way we have here in the United States. It's not happening. I want to understand from your perspective how you will work with the banks in America going forward from here, because there's a start of a new trend where the banks will originate the loans and then you'll provide the money. How's that going to work in years to come? How big could that opportunity be?
Oh, I think 24 was a pivot year. You know, for us as a leading firm in this industry and in this sector, you know, there was a great headline, and you and I talked about, the three of us have talked about on this show many times, where the great battle between private capital and banks. The reality is, if you look at the commercial dialogue going on between the top 5, top 10 institutions and the handful of us that lead our industry, the amount of integration, dialogue, working together on big deals has never been deeper. Obviously, there was our Citibank transaction, our Citigroup transaction, there was a transaction we did with Standard Chartered, BNP, and so I think we're still at the early days. These partnerships need to have substance. They can't be, excuse the phrase, shotgun marriages. They have to be ones that really have substance, dialogue, trust, and some history of doing a lot of transactions together. We've been fortunate in all the ones we've put together where there has been a lot of either history of personnel or of activity. But I think still it's early days, early innings. Now, there's a lot of headlines just to grab headlines, and there's not a lot of substance behind them. But I think that trend of private capital and bank partnerships is going to extend in 25 and 26. And I do think, if you think about the economic backdrop, I do sense that there is a great opportunity for strategic M&A. That clearly feels like it's going to happen. I'm a little bit more skeptical about the massive IPO window. If you look at the last 10 years, equity issuance has been about $250 billion, 50 billion IPOs, 200 billion secondaries. That's removing all the SPAC numbers. I think you still have a valuation issue with a lot of private equity companies that want to come out and do their IPO. And so I think we have a consensus view or non-consensus view at Apollo that number is going to be not as large as people think. And so the big mismatch, if you have a big credit market, a big equity market, this area of hybrid in between, which we've been talking a lot about, applying capital to those over-levered companies, that's the opportunity of 25 and 26.
Just to build on the IPO issue just a little bit more, is that just a valuation issue, or do you think it's a role that you have to play here, that these companies don't need to go public anymore?
It's a combination of both. It's a great question. I think it is a valuation issue for probably 50 to 60% of them. I think it's very, very clear now private companies have access to all sorts of capital, debt and equity, preferred, convertible, whatever it may be. And so the typical route where you needed to go to have your employees be able to monetize their investments, broad-based capital, equity, revolvers. You saw what OpenAI did several months ago, bringing in a bank facility. There's tremendous pools of capital, private capital, that can fund and finance these companies. So going public is by no means the ticket to liquidity that you needed in the past. A lot more options.
In 5 to 10 years, will there be a difference between public and private markets?
We don't believe so. I think there will be some differentiations, and I think the question that gets raised right after that question that you ask is, well, is there going to be a massive compression in yields? And the advantage is going to go to those folks that have the bigger, you're going to make money on the origination. The ability to make the $3, $5, $7, $10 billion commitment to XYZ company, that's where you're going to garner the extra spread. But all the things that we're doing in origination, in capital formation, in trying to bring some liquidity to these markets in terms of secondary activity with transparency and price discovery, I think the barriers and what's private is risky and what's public is safe. I think those barriers will be coming down. And again, I go back to this Berkshire. No one really talks about it, but it is quite an irony that the greatest public investor of all time 70% of those companies, when you look at the web page, these are some great American companies. And over 50 years, he's assembled them, and they're massive compounders. And that's 70% of the underlying value. Geico being at the top, Clayton Homes, BNSF, many, many other great companies. And I think that's a lesson for us all. There's companies that are private, and there's private equity. You should differentiate between the two. But we clearly want to be part of that big trend and offer those to investors and retirees around the globe. It's a big change in market structure.
You're going to be sticking with us to talk about that change in market structure and the changes we could be seeing in Washington, D.C. a little bit later this year. Jim Zelter there of Apollo Asset Management. Let's give you an update on stories elsewhere just briefly. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. More than 100,000 Los Angeles residents have fled their homes as at least 5 massive wildfires burned across the region. It's the worst natural disaster in the city in decades. AccuWeather estimates that the fire will cause $52 to $57 billion in damage, making it likely the nation's most expensive wildfire. Apple, meanwhile, says that it never used data from Siri to build marketing profiles and that it didn't sell that information to anyone for any purpose. This statement comes after Apple agreed to pay $95 million to settle a class action lawsuit alleging that user privacy was violated when human reviewers listened to Siri recordings. Apple says that contractors listened to recordings only to improve Siri's voice recognition, and recordings are only retained if users explicitly opt in. And in English football, some big upsets. Tottenham edged out Liverpool in a 1-0 match in the opening leg of the semi-finals at the EFL Carabao Cup. 18-year-old Spurs midfielder Lucas Bergvall scored the winning goal in the 86th minute. The match follows another upset, Newcastle's win over Arsenal in their semi-final match earlier this week. Arsenal coach Mikel Arteta complained of the quality of the balls being used in the tournament. Both teams will face off in the second leg of the semi-final in early Feb. And that's your brief. John.
Hey, Danny, thank you. Who put Tottenham in a brief? Who did that? Up next on the programme, cutting the red tape.
Any business that invests $1 billion or more in the United States will be eligible for fully expedited permits and approvals, including environmental approvals from the federal governments.
That conversation up next, live from New York City. This is Bloomberg. Equity futures on the S&P 500 negative by close to 0.2%. If you check out the bond market, stabilising a touch. We're down 2 basis points. Call it down close to 3 on a 10-year, 466. Over in the United Kingdom, things stabilising just a little bit. I won't get too excited. Yours are still higher by 3 basis points. The 10-year over there, 482. Under surveillance this morning, cutting the red tape.
Any business that invests $1 billion or more in the United States will be eligible for fully expedited permits and approvals, including environmental approvals from the federal governments.
They took away 625 million acres of offshore drilling. Nobody else does that. We're going to be drilling soon. We're going to be opening up Anwar. We're going to be doing all sorts of things that nobody ever thought was even possible.
So here's the latest this morning. President-elect Donald Trump pledging to draw global investment to the United States, slashing permits and approvals for investments of $1 billion or more. Trump also vowing to overhaul the nation's energy sector by opening more space for offshore oil and gas drilling. Jim Zelter of Apollo is back with us. Jim, I've got to ask you this, and we can move on quickly if you want to. How close were we to losing Mark Rowan to the swamp down in Washington, D.C.? How close did we come?
Well, I think that the administration saw an amazingly bold thinker and who would have had a huge impact on the future trajectory of our economy and our the far-ranging responsibilities of the Treasury Secretary. And I think he was, very engaged in the process. But America's loss is Apollo's gain, and we certainly feel we have a great, deep management team that could carry the water in his absence, but he was very engaged in the process.
Let's build on your gain, and that's diplomatically put. In early November, when we got this election outcome, your stock was like a rocket. What were investors seeing? What do you see as an opportunity of the incoming administration? What kind of changes are you expecting that might benefit your business?
Well, I think they've seen in our particular example, we've been a company that has grown over the last decade by being at this intersection between retirees and investors around the globe and companies needing to raise capital. And as the markets have evolved, we've continued in a low rate environment and a high rate environment. We've been able to continually, 15 to 20% growth of our business every year. And they see that in an environment where we're going from an administration that was clearly not pro-business and not as pro-growth to one that clearly is pro-growth, a regulatory environment that clearly has changed. So I think the view has been, if these folks have succeeded so well in an environment where there's been an administration that was not cheering them on to one that's clearly cheering them on, that's a better backdrop of a broader success. And I think that's what we're seeing right now. Certainly the refreshed view of a regulatory backdrop, this refreshed view of M&A, the refreshed view of bringing capital into the United States and having capital really provide a lot of this growth, whether it's in technology, whether it's in the onshoring of companies. We're feeling the backdraft of that, which I think is very, very positive.
Well, I want to pick up on that, the idea of financing some of the technological advancements. We've heard a lot about that, whether it's some of the warehouses, whether it's some of the energy grid. What areas is Apollo going to double down on as a result of maybe more free permitting, more acceptance, and frankly, some of the sentiment that you were talking about?
I think you've identified them. Certainly when you look at the big TAMs of infrastructure, of data centers, of the utility grid, of that broad infrastructure, all of those by many, many investment-grade companies, even the highest-rated investment-grade companies. Witness what we did last year with Intel. There's a whole slew of those that are looking at massive CapEx needs, and we've talked about it here in the past. As much as the investment-grade market is a very robust, open market, a lot of the growth that these companies are confronted with are well in excess of what can be financed purely with the investment-grade market with their existing ratings. So you've identified 4 or 5, and they're really in those big pools of economic growth of infrastructure, technology, digital, data, all of those areas, which many U.S. companies, as well as the onshoring of foreign companies coming to the U.S., wondering how they're going to finance these activities. So, as I said before, since the Intel transaction, we have been incredibly busy. I would argue I've used the term phone ringing off the hook about the dialogues we've been in with a variety of these investment-grade companies looking to finance their business in a variety of manners.
And certainly there's a belief that the incoming administration, Lisa, is going to have a more pragmatic approach to the energy needs that are going to be required to support some of these shifts. That's for sure.
With respect to drill, baby, drill, there has to be a host, though, of different energy provisions, and that's one thing that we keep hearing. Key question for a lot of people is how consistent can some of the regulatory parameters be, and that's why some of these connections are for many years in terms of the investments and some of the big tech companies that are making some of the financing.
Well, also, these are long-duration investments, and again, this is another theme that really came to the surface last year in terms of what the market has really embraced is the duration of the capital that we have with our annuity and retirees that many of our peers have as well, but the scale and the integrated manner that we've brought that to the forefront, I think that's what the market has embraced.
Jim, you're one of the best. We appreciate your time.
Thank you.
Being with us. Thank you, sir. Jim Zelter there of Apollo Asset Management. Up next, Alex DaSilva of AccuWeather as devastating wildfires continue to threaten Los Angeles. Equity futures at the moment pulling back by 0.25% on the S&P. We're down by about 1/3 on the Nasdaq 100. On the Russell, would you believe it? The Russell is basically flat since the election. After that massive month of gains in November, we took almost all of it back in December and some to kick off 25. It's kind of amazing, isn't it?
It is amazing until you see the buzzkill, which is bond yields, and then you say, wait a second, this is exactly what some people warned, that the stock market would like some of the proposals, the bond market wouldn't, and oh yeah, the bond market might be in the driver's seat.
Fireworks in the global bond market. Let's get you some of those fireworks right now with Bloomberg's Manus Cranny. Morning, Manus.
Jonathan, Lisa, good morning. You're right. The depth charge that started in the United States was a debate about term premium, not about inflation. It was a debate about the trajectory of the Fed. We've broken trend, so yields are down by 3 basis points. This is a bear raid, not vigilantism, That has got to be put in context. We've sort of broken higher, but not to the extent that you saw in 1994, where bond yields exploded by 5%. So it erupted here, and the triage is for the rest of the world. And what do I mean by that? We're going to begin to discover who really is swimming naked when the tide goes out, fiscally speaking. And this is where the disruption is in the United Kingdom. Levels that you haven't seen since 2008. Again, put in context. People are talking about a Liz Truss moment. This is not a Liz Truss moment in the bond market yet. In 2022, the bond market erupted by 100 basis points over the period of a couple of days. This is 30 basis points in the space of a week. But what we have here is, how do you constrain this? And I like what you said earlier from Jordan Rochester's note. I mean, people in the brokerage community are saying the great British peso and the Istanbul on terms. The question is, fiscally, what happens in the United Kingdom? And when you have Martin Wheel, ex-Bank of England, talking about 1976. 1976 is when the UK went to the IMF for a bailout. That's not what people are calling for, but Martin Wheel is writing about it. So how do we stop the rot? Have a look at the US bond market. One big, beautiful bill. That is the narrative, that is the mantra from the Biden administration and from President-elect himself. The question is, what triggers a real dislocation in this bond market? Is it additional tax cuts above $5 trillion? The real yield is the important thing here, Jonathan. And what you're seeing is a mini bear raid in the US, morphing into a global dislocation. But this is a lesson for this US bond market, that if you push the fiscal envelope too hard and too fast and too aggressive, the whipsaw can be pretty monumental. 1994, go check.
Manus Cranny, you lived it. Appreciate the update. Thank you very much, sir. Looking forward to payrolls tomorrow morning. 165,000 is the estimate in our survey. The previous number is 227. There's been a few occasions over the last 12 months where we've said good evening Tokyo, because we've believed that Japanese authorities are following the economic data so closely, given what was happening to dollar yen. I think we've got to say good afternoon London tomorrow morning when we get those numbers, right? That's going to be a big issue for the UK.
Even more so than good afternoon Tokyo, because Tokyo is doing just fine with some of the wage increases that they've seen. It really is now about the United Kingdom and, frankly, about Europe, that's feeling some of the pressure from higher yields globally that are impacting markets that don't have the same amount of growth.
Under surveillance this morning, gilts extending a fourth day of losses on concerns the UK's Labour government will struggle to keep the deficit in check. Some investors drawing comparisons to both the 22 gilt crisis and the 76 debt crisis when the UK government asked the IMF for a bailout. The pound also falling to a multi-year low. Pound sterling, Lisa, 122.78.
This is important. Essentially, what this shows is that as yields go up, fewer people want to come in, and that is going to be really the hallmark of the great British peso, as we just heard about from Jordan Rochester, that was mentioned by Manus. This is really the concern. How much is this becoming an emerging market type of behavior that really does make it difficult for this administration to alter the ship?
Well, let's talk about that administration. They've got internal problems and external problems. The internal issues, spending too much money. One, on the monetary policy side, QT. Probably not the best time for QT. Let's see what happens there. Then there are external issues. They're importing weak growth from Europe. That weak growth is being imported from China. And then you've got what's happening with global markets, driven by the United States, which is the point that Manus was making. The external issues are much, much harder to address. Growth's not going to pick up anytime soon on the continent. It's basically flatlining to worse in certain regions. And in the United States, this administration is hell-bent on making sure that we live in a high nominal growth world in the United States of America. And so long as that's true, there's going to be pressure on bond yields upwards, and that's going to be exported to the rest of the world, and we're seeing that play out in the gilt market.
There's one feature in this scenario that you paint very well that's interesting to me, which is that in the UK, they're trying to raise taxes to pay for some of what they're doing. In the US, the goal is to cut taxes to juice growth. That divergence right now is benefiting the US at the behest of the likes of the United Kingdom. And I'm curious about the history books of how that gets written.
It's a real crowding gout. It's been a theme of this programme for the past few weeks. There's a real crowding gout taking place. Let's keep it here in the United States. President Biden planning an additional round of restrictions on AI chip exports. Sources telling us here at Bloomberg that Biden is looking to curb the sale of AI chips, including from sector giant NVIDIA, on both a country and company basis, focusing on development in friendly nations.
So there are a lot of questions here, not least of which is how much this is actually going to remain in place through the Trump administration. But it remains this issue of where is it okay for U.S. technology to be implemented outside of the U.S.
What's a friendly nation?
What is a friendly nation?
Is Japan a friendly nation?
Exactly. And this becomes the heart of the issue. If basically it's not just NVIDIA. This is a matter of Google or Microsoft creating a data center in another country, because that also is within one company exporting those chips in order to create that center. So how narrow is our group of allies, and what was the goal of this particular credo at the twilight of his term?
The Biden administration having a very busy close in the last few days, that's for sure. The president also cancelling a planned trip to Rome as wildfires continue to threaten Los Angeles and surrounding areas. The White House saying the president is staying in the United States to, quote, remain focused on directing the full federal response in the days ahead.
Well, and this is probably more on par with the tone right now than, say, the mayor of Los Angeles, who I believe is still not in the United States, is still in Ghana. But there's this question here about how you prevent this from going forward, and then how you tackle this in real time when they're running out of water. I mean, it's an absolute catastrophe, and it raises a lot of questions structurally about how you prevent this, how you redevelop, and frankly, how you insure properties where a lot of them had stopped being insured because the insurance companies couldn't raise the premia. So they just got out of California altogether. It creates this real mess.
A victim of their own regulations.
Well, we can call it whatever we want. We're going to be dealing with the aftermath for quite a while.
Difficult to track the mayor, but I believe the mayor is back. But I think I think the issue that the mayor has got is the issue that the president of the United States has got as well. Let's be honest. I'm not sure how much the president of the United States is actually doing right now to help out on this situation. But if he was in Italy, he'd be criticised. That's for sure.
So it's a public relations thing. Sure, he's not out there fighting the fire personally, but a lot of this is an important tone. You need to show, if you've got 100,000 people who have been evacuated from their homes and more, and there are hundreds of homes that are being demolished, I mean, a joyride?
Let's keep it on the wildfires. Those wildfires forcing more than 100,000 residents to flee the area's worst natural disaster in decades. AccuWeather estimating the total economic damage will be between 52 and 57 billion US dollars. Joining us now is Alex DaSilva of AccuWeather. Alex, thank you for joining the program. What's the latest this morning?
Yeah, we still have 3 major fires burning on the north side of Los Angeles right now, all of them less than 10% containment right now. There's even a few fires that have popped up around the area as well. Those are much smaller and do have, fortunately, some containment. But again, those 3 major fires, the Palisades, the Hearst, and the Eaton fire, all 10% or less containment. Now, let's take a look at the winds. What are they doing? Because that is the major question. Are these fires going to get worse? I have some good news. The winds did back down considerably last night, but it does look like they're going to pick up a little bit today into tonight. So we're looking at winds of 30 to 50 miles per hour. The good news is that's down from the 70 to 90 miles per hour that we've been dealing with over the last day or so. But again, still going to be windy across the Los Angeles area. I do think that these fires are going to continue to make some progress. But again, the winds have come down a little bit, so the firefighters should be able to make at least a little bit of progress as we go throughout the day today. Like you just mentioned, AccuWeather estimating $52 to $57 billion in economic damage from these wildfires. It's not just the physical damage, it's the tourism damage. And it's a lot of those repercussions that kind of come after the event. So it's not just about what's going on currently, it is how are these going to impact the future? And so that's all baked into this estimate of $52 to $57 billion in damage. The question is, how does this compare to other natural disasters? On top, you see the $52 to $57 billion in the California wildfires. In the 2020 wildfire season, many of us remember that. That was such a destructive season. That was $130 to $150 billion, but that was over the course of the entire wildfire season. This is almost half of that, and it is in just a couple of days. And then you can see how it compares to Hurricane Helene with over $200 billion in damage.
Do we have a sense, Alex, of who's going to be paying for some of these damages?
Yeah, I'm not sure. I think the federal government is probably going to be aiding in some of these repairs that are going to have to be made. But like I said, the damage is not done yet. It looks like that some of these wildfires are going to continue to spread. So, certainly a disaster declaration will have to be declared probably in this area, and federal money will have to come in, I think, to the Los Angeles area.
Alex, appreciate your time this morning. No doubt we'll catch you up with you before the weekend. Alex DaSilva there of AccuWeather on the latest in Los Angeles. With an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. First, the latest in the battle to stop those wildfires. The U.S. military is ready to help. Defense Secretary Lloyd Austin said the Pentagon will provide aircrafts to help extinguish the flames from the sky. At least 5 massive wildfires are burning across Los Angeles, as we were just hearing. 27,000 acres have been scorched, 5 people have been killed, and 100,000 have been forced to flee from their homes. A union representing U.S. dock workers has reached a tentative deal with port operators for a new 6-year contract that avoids a strike. Bloomberg has learned that the agreement guarantees union jobs when certain technologies are implemented. That includes the semi-automated cranes that had been a sticking point. The deal still needs to be ratified by the two sides. Hershey is asking the U.S. government for permission to buy huge amounts of cocoa. Concerns surrounding the global shortages of the commodity have soared, and record high prices expected to persist for a 4th straight year. Hershey is seeking to purchase over 90,000 metric tons of cocoa. That exceeds the U.S. Commodity Futures Trading Commission's limit. And that's your brief. John.
Danny, thank you. I'm surprised there's actually that much cocoa in Hershey's.
Oh, really? You're going to go there?
I'm just saying I'm surprised.
I was just going to say that explains why I couldn't get my bushels.
How much chocolate is actually in the chocolate?
Okay, I know.
We'll talk about this another time, all right?
All right. How do you eat our chocolate?
Love chocolate.
Do you actually look at the percentage?
Yeah.
Of course you do. And you only do above 70%, right?
60% and up.
60% and up is okay?
Like that,
you can do that.
That's too high, I sneeze. Got an allergy in there somewhere. Up next, seriously, Donald Trump's agenda turning into reality.
Given our small margin in the House, we're going to need everybody's vote and everybody on board. Our Senate and House Republican majorities are going to have to work together.
Seriously, I don't know what it's about. Anyway, down in Washington, up next on the programme, we'll catch up with the former Speaker of the House, Kevin McCarthy, sitting down with Anne-Marie. Equity futures on the S&P 500 negative here by 0.2%. Call it down by 0.3, 1/4%. Yield to lower 2. That's helpful. We're down 4 basis points. The 10-year 4.65. Under surveillance this morning, Donald Trump's agenda turning into reality.
Given our small margin in the House, we're going to need everybody's vote and everybody on board. Ultimately, our Senate and House Republican majorities are going to have to work together. Nobody's going to get everything they want out of this. There's going to have to be a good faith negotiation if we have any chance of passing a reconciliation bill.
So here's the latest. President-elect Donald Trump is back on Capitol Hill discussing his priorities with Senate Republicans and telling reporters whether it's one bill or two, there will be results. Anne-Marie joins us now down in Washington with the former House Speaker, Kevin McCarthy. Anne-Marie.
Good morning, Jonathan. Well, I love what Majority Leader John Thune said. It's clear as mud in terms of the sequencing, but the priorities are clear for President-elect Trump in order to get his agenda through. And we're going to talk about that right now with former Speaker of the House, Kevin McCarthy. You know how challenging it is with slim majorities to get anything done in Congress. What's your advice to President Trump? Does he go for this one big, beautiful bill, or does he lean on the Senate, who wants to see a 2-track approach?
I think one bill is the right answer. And this is why. You've got to understand for you.
But is it big?
Well, this is the point. It's different, okay? This is the first time in modern history the majority in the Senate is larger than the House. So the Senate's going to have a different view. They've got 53, but they really have 54 by having the vice president. The House even has a smaller majority than it had in the last Congress. They lost seats while everybody else won. Plus, come January 20th, they're going to lose 2 more members for a time period. Those 2 Florida seats won't get filled till April 1st, and then the New York seat won't get filled till after that. So you can't take that many bites of the apple. And remember for your viewers why you're doing reconciliation. It's a special provision that allows you, if your party controls the Senate and the House, to pass in the Senate without 60 votes. But you can't write a perfect bill. So this is how the Democrats did Obamacare. It's how we did tax reform. You've got tax reform you have to get done by the end of the year. Otherwise, your taxes all go up. So the pressure is on you. If you make the bill too big and too beautiful, most in history, it collapses upon itself because it's too big. The reason why they're looking at 2 different bills, they need money now for the border. But I believe the border is a disaster. Declare it a disaster. Pull money from the disaster fund. You're going to be putting more in for Californians and let you do the border right now because tax will take a little longer. The other problem they have, though, is they made a mistake. They never finished the funding from last year, and this is a disadvantage for Trump. They hurt Trump by making him worry about last year's funding now, which is due in March.
Was that a fault of Speaker Johnson?
I don't know whose fault it is, but they should have got the job done, okay? And they should have done the debt ceiling already. So these are two provisions that the Democrats could use to an advantage and slow down your agenda. So the first thing I would do, you still have time now, finish the funding from last year and take care of the debt ceiling so President Trump could have the honeymoon or the agenda he wants to start putting forward. Because we're now they got to confirm in the Senate the new cabinet. He's got to get his people in line to start working. But President Trump knows this job already. He knows he's got 4 years. He's not going to waste one moment. He'll do tremendous on the executive orders, but he needs the legislative body to catch up to him.
Who's going to be that moderating voice to make sure that it's not too big so that it doesn't actually collapse?
Well, it's what I love. It's the free market. It's a natural that you'll see.
So you think it's this bond market? We've seen yields go up. People starting
to
be very
that's going to be on
concerned
the
about
debt.
Financial discipline. Do you think the bond market does Congress have room to spend as much as Trump's rhetoric is talking about?
Well, the problem is Trump's just now coming in. It's like I'm taking over a company. And remember what the debt ceiling is. You've got to give him leeway. So all it says is paying the debt that the last people had spent. But the debt ceiling doesn't solve all these problems.
The market right now is pricing in his future plans and spending. Will that be the moderating force?
You're not counting in Doge, okay? And what I look to Doge, I think this is good because it gives people the opportunity. But the way to handle this, and I tried to get Biden to go for this, in 1989, the Soviet Union collapsed. So we needed to reform our military, all designed to fight the Soviet Union. But what member was going to raise their hand and said, close my military base? Nobody, but you need to. So you created a commission, but this was the important part. You had teeth to it. If they got their work done, it got a vote in the House and the Senate with no amendments. And lo and behold, it passed. They need to do something like that for Doge. When Doge gets their work done, let them vote in the House and the Senate with no amendments, and you'll know whether you can get it. I think one of our greatest threat is our debt, okay? But we've got to do a lot of things going forward. The debt ceiling is not a part of that. You should take that out of the way, let the president be able to govern, do the job that has to be done.
Are you feeling that this can potentially be done, though, in April, what Speaker Johnson's talking about? All of this? New spending, reconciliation, and a disaster?
Well, I think it's hard to say by April 1st because you haven't put every vote matters. I'd wait till the Florida seats because that's 2 more seats. You can't get tax done that fast because remember, tax, they're going to do something about salt. They're going to do something about tax on tips. That costs money, so how are you going to pay for it? But you've got to start working on the border. So take that money from disaster and do the executive orders. Get that done. You want to do something on energy. But if you put the debt ceiling to reconciliation,
which is what people are talking about,
that won't work. And this is why. Because there are members in the Republican Party that will never vote for it. And you have no votes to spare.
The House Freedom Caucus.
Yeah. So you should.
Who wins that fight, Trump or the House Freedom Caucus?
Well, no. Trump will always win. House Freedom Caucus loses from that perspective because the House Freedom Caucus is then saying to the American public, your taxes are going to go up. And you know, you've watched in the House Freedom Caucus, their former chairman was anti-Trump. They have anti-Trump people in that caucus, and it's unfortunate. So nobody can fight here. They've got to focus on priorities, but they've got to focus on the policy. You're not going to get it 100% right, but government isn't designed that way, right? You've got to have conflict because you've got to deal with the Senate. But you'll get this done. It's in the sequencing of how you do it.
I also want to ask you, you mentioned California and the disaster at the top. How do you think Trump is going to deal with when he's inaugurated and the incoming tragedy, devastating fires that are apocalyptic, people not having their homes, not having enough water, not having enough firefighters? How is he going to work with Democratic Governor Gavin Newsom to solve this crisis?
There's a third point, too. A lot of these families lost their insurance in the last 6 months because of Gavin Newsom's inability to deal with this problem.
You know, the insurance companies wanted to raise the rates.
They wanted to be able to make sure they can afford to insure. When he wouldn't focus on that issue, they have left the state. My mother lost her homeowner insurance from Geico, and she had no claims because California was uninsurable, and they ignored the problem. He gallivanted around. You know the saddest part about all of this? We've had these fires before. I went out to California with then President Trump, November 17th, 2018. We just had Paradise, where 85 people died. And we toured that with Gavin Newsom, who had been elected governor, not sworn in, and Jerry Brown. And then we flew down to Malibu, that had a fire as well. I was in the meeting walking these places where President Trump is saying, you got to take the fuel away. Yeah, you're going to get a fire when there's wind and push it, but if it doesn't have fuel, it can't keep growing. The other problem, too, is had you worked on the evacuation ahead of time, instead of these cars getting stopped and people, that's what happened in Paradise. What about the infrastructure? You can't go to a fire hydrant and not have water. And President Trump worked on providing the water further, and you know who fought him on it? Gavin Newsom.
But looking ahead, Trump is going to come in and want to make sure that California gets the money they need.
I think you're going to see Trump will be there for California. But what Trump's going to do, too, is you can't keep repeating the same mistake. I think you're going to see executive orders pretty early about the water again. The President Trump did that last time. Had Gavin followed through, we would have had water. President Trump was very serious about making sure taking out that fuel, protecting it, managing it so you won't have that. You're going to see him double down even harder on this. But California, the state, they've got to change their behavior. And I think what President Trump will do is put the mechanism is where Gavin cannot make this mistake again.
Since you left Congress, I know you've been focused on AI. I just want to end on this. But you've also become an informal advisor to President-elect Trump. You were at Mar-a-Lago just last week. Do you see yourself going into government, or do you like being that call on the outside?
Look, I served for a long time. I want to utilize the knowledge I have from being Speaker and everything else, and also on the outside, that Congress starts looking at the issues the next 50, 60 years. I mean, if Congress is looking back to do the funding from last year, we're losing the battle for the next century. And I firmly believe whoever captures AI and quantum. So these are all the issues I worked on while I was Speaker. You know, I went to MIT, which teaches a course to all the generals in our military. 4 years ago, I had to develop a course to teach it to all of our members of Congress. The China Select Committee, right? The AI Committee. So whoever captures AI and quantum has the advantage. But if you want to capture AI and quantum, you've got to get the energy policy right. Otherwise, it'll never happen.
Yeah, the data centers.
So what I'm doing in the Alpha Institute is literally just policy, showing a roadmap for the policymakers to solve those problems. Just continue what I did while I was working there to help the policymakers and America succeed and be successful.
Former Speaker of the House, Kevin McCarthy, thank you so much for your time. John, it's clear he thinks one bill, but it might not be so big.
We'll see. Watch this space. A big space. Maybe a really big space, or maybe not at all. Look, we're talking about numbers of 4, 5, 6 trillion. We spoke to a guest just yesterday who was expecting a bill as big of $6 trillion US dollars.
You're not counting Doge. That ultimately is going to be the question. But this is the issue, right? How do they get those cuts through when this isn't necessarily a cabinet position? That's going to be actually one of the most interesting aspects of these negotiations.
I agree. In the third hour of Bloomberg Surveillance, here's your lineup. Greg Boutle of BNP Paribas, Craig Moffett of MoffettNathanson, Jonathan Pingle of Natixis, and Theirry Wizman of Macquarie. From New York City, this is Bloomberg.
The equity market can move higher, but obviously people are worried about more of a melt-up in rates.
Rates are the things that pressure equities.
A lot of uncertainty with regards to what's happening in terms of bond yields.
Fiscal deficit, inflation issue that's not solved. All of that is in the mix and it's pushing up yields.
I think the bond market here is pricing in the worst case scenario for what the upcoming administration could or might do.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 just a little bit softer. We're down 0.1% on the S&P. Some important times for today's session. Anne-Marie's down in Washington, D.C. to observe a day of mourning for the late President Jimmy Carter. That funeral taking place. It means some changes to market openings and closes. The cash equity market will not open today, so that is closed. Equity futures are trading, but they will cease trading at 9:30 Eastern Time. And the cash treasury market will close a little bit earlier today at 2 p.m. Eastern Time. So some times to think about as we progress through the market day. As we think about the bond market, let's check out treasuries to begin with. Treasury yields are heading just a little bit further lower. On a 10-year yield, we're down by 4 basis points. On a 30-year, we're down by 5. So pulling back from these multi-year highs. In the UK, things stabilising as well. Lisa, looking at the gilt curve right now, just about unchanged.
Which raises this question about, again, how much the U.S. is setting the tone for the rest of the world. If there's a bid in the U.S. Treasury market, does that give a reprieve to Rachel Reeves and the entire U.K. government that's grappling with something that rhymes with Liz Truss? Maybe it isn't exactly Liz Truss. And Liz Truss came out yesterday with a cease and desist letter to the government saying, guys, I did not torpedo the economy.
Do you feel sorry for Liz Truss yet? That every time there's a bond market sell-off, it's called a Liz Truss moment.
Well, maybe she should just embrace it because it's not going away.
Lehman going under, like a Lehman moment, and now it's a Liz Truss moment.
Do you imagine if that was like sort of your reputation?
No,
that's the reason why she's sending a cease and desist letter yesterday, right on cue, as we get something that rhymes somewhat with, I have to say it, a Liz Truss moment.
The global bond market will be focused on one data point tomorrow morning, 8:30 Eastern Time. Payrolls Friday. 165k is the median estimate in our survey. The previous number is 227. I think that the British authorities are doing that. Talked about this yesterday and saying, please, a downside surprise.
Yeah, although I've been thinking a lot about this. Would it be something that would be positive for risk assets in the U.S. if you did get a downside surprise and then the commensurate rally in the Treasury market that a lot of people are expecting? On one hand, you take some of the pressure off from yields. Well, that should be a good thing for stocks, given that the relationship has inverted recently. On the flip side, there is this issue that if you have weaker growth, what is the argument to keep going into stocks at elevated valuations at a time where we still haven't left inflation behind?
Equity futures right now down by a little more than 0.1% on the S&P. Coming up this hour, we'll catch up with Greg Boutle of BNP Paribas. As last year's rally hits a little bit of a wall, Craig Moffett of MoffettNathanson on why Apple is due for a big pullback. Look out for that. Big call from that team. And Jonathan Pingle of Natixis, the most accurate forecaster of payrolls on Wall Street. We begin this hour with stocks inching lower as investors await tomorrow's payrolls print. Greg Boutle of BNP Paribas saying volatility dynamics have been consistent with what we described earlier in the year as late cycle exuberance. Stretched valuations, positioning excess and volatility suppression have all started to amplify risks of disorderly corrections. Greg joins us now for more. Greg, good morning.
Good morning.
That's a Bramo-type statement there at the top of this programme. Disorderly corrections, where are we seeing those?
Yeah, so I think we got like a little bit of a sense of that in December, where what we had is this environment where equities were trending higher, huge inflows came into the market post the election. And then when we had a negative catalyst, we broke from this very low volatility regime into a big risk-off move. We've got a 3% down day in the S&P. We've got a 12-point one-day increase in the VIX. Large dislocations based off of the kind of negative surprise associated with the FOMC. So that's, we think, a little bit of a playbook for some of the environment that we could be in for this year.
That goes against some of the hopes and dreams post-election of a market that broadens out. And then we saw all this negative breadth, that the Russell, the small caps would start performing, and then basically the Russell's rolled over and we're unchanged since election day. What is it going to take for this market to broaden beyond Mag 7?
Yeah, I think the price action is amazing. We got these huge one-day moves the day after the election, and then we saw some follow-through, but that totally evaporated through December. So what we need to see is evidence of breadth coming in from earnings season, and we need to see this kind of macro environment remain in a kind of Goldilocks type state where the data is good. We do need strong nominal GDP growth, but not too hot that the bond market derails things.
I'll take your disorderly corrections, and I will counter it with something Nick Colas of DataTrek was talking about, which is he lived through the 1995-1999 period and the subsequent 2000 to 2002 period. And he said the hallmarks of the sell-off was higher volatility. And we're not seeing that. So without that, and given the fact that there's something behind some of the dynamism people are talking about, he remains fully bullish. Why do you reject that? Why don't you think that it is an indicator that we haven't seen a real spike up in the VIX?
What we've seen is quite a nuanced volatility market. So if you do look at the VIX behavior through the second half of 2024, you do have some evidence that it is starting to become more reactive. So we think we're in an environment where there's an awful lot of volatility selling, which has a self-feeding mechanism of suppressing volatility locally, but then potentially you can get some breaks out of that where the market becomes more volatile. So we saw two instances in the second half of last year, one in August, one in December, where we had some very large spikes in the VIX that quickly mean reverted. And I think that's slightly different behavior than what we've seen in the 12, 18 months prior to that.
Is that what you're talking about with the disorderly correction? Is that sort of the contours of it, or are you expecting something slightly different as this year goes on?
No, I think the regime that we saw in the back end of 2024 is something that we think continues into 2025. So this isn't to be confused with just a pervasive bearishness. We think Q4 earnings season is going to be the most important catalyst in January. And it wouldn't surprise me if we see the S&P make new all-time highs. But as the market moves higher and we get more and more risk building in the system, it then leaves us vulnerable to these very rapid unwinds where the VIX can spike aggressively and we can move from a very low vol regime into a high one very, very quickly.
JP Morgan reporting fourth quarter earnings next week. I think Delta is actually the first. But JP Morgan sort of kicks it off, and that's going to be something interesting. I know you're laughing because, of course, I'd pay attention to Delta reporting earnings first.
No, I'm with you. And I'm laughing because I think JP Morgan likes to think they kick off earnings season, even though another company does.
So just let's give Ed Bastian his due. He is kicking off earnings season. I guess it goes to the heart of the question. What's more important, growth or the rate regime?
I think it's both. So what we need for equities to perform here is to have strong growth. We can have a little bit of inflation, high nominal growth that drives high earnings growth. And maybe we can digest kind of gradually higher rates, but what we need to avoid is a rapid spike in yields. So I think if we were to see the 10-year yield, for example, punch through last year's highs very rapidly, that would drive a risk-off move for equities. What we need to see is this kind of classic Goldilocks environment where rates can stay higher for longer, but are not moving in a very volatile fashion, and we get strong nominal GDP translating into strong earnings growth.
What degree of confidence do you have that we're going to get that?
I think we might get pockets of it. I think our whole thesis for this year is that it's going to be really tricky to navigate. I think there'll be some parts of this year when it feels a little bit like 2017 from Donald Trump's first term, which was the lowest volatility year, despite some of the headline risk for equities in 50 years. And then we moved into 2018, where we had trade and tariffs dominate. We had a hawkish Fed in Q4 2018 derail things.
Volmageddon at the start of the year.
Volmageddon, exactly. And I think that's a good example of where volatility suppression, an ultra-low realized volatility environment in 2017, built up too much risk that then unwound very aggressively in 2018.
So it's a blend of 17, 18 that you're expecting.
And I think that one of the key features of this market is that it's going to be very episodic and we could bounce from one regime to the other very quickly. So we think that using the optionality market, there are ways to position yourself to try and navigate that. But we do think we'll get this kind of strange conditions where volatility is not homogenous. It's not a high volatility or a low volatility environment. It's high vol.
What's the opportunity right now then?
Well, I think that there's two things that we're looking at. One is looking at the stocks or sectors that you like, where you think that there could be good releases through Q4 earnings. We think we've seen a big retracement in some of those stocks from the highs. So I think there are opportunities to add some risk there. And then I think there are opportunities to hedge. I do think that when we have periods of de-risking, the VIX will be explosive. And that's something we think we can take advantage of.
Like a 2018 explosive or just like 10 points in a day explosive?
So I think depending on the news flow, I mean, we had 12 points in a day in December. And that wasn't an environment where things were really breaking or anything was going on. So I think we can get bigger moves than 10 on the VIX.
So is this another way of saying that there isn't a lot of conviction and direction, so just play with the market on a day-to-day basis?
Yeah, I think what we've called this is late cycle exuberance. And what you see is these pockets where people put a huge amount of money to work and the right tail can essentially overshoot. And then you can have these large periods of de-risking. So I wouldn't necessarily say it's day-to-day, but it is month-to-month, quarter-to-quarter. You know, we're much more focused on where do we think the market is going, what are the opportunities in the next month or 6 weeks, than we are thinking about where the market will end the year.
So how much are you trading January 20th?
So I think January 20th is one of the key catalysts in what is a catalyst-packed January. So, I mean, tomorrow we have the payrolls print, then we have CPI, we have the FOMC at the back end of the month. Q4 earnings, I do think, is probably more important than January 20th. But January 20th, I do think, is something that we should be mindful of. It falls 2 days before the January VIX expiry. So if we were to get headlines that the market didn't like in and around January 20th, again, I think the VIX could be explosive.
So no one's listening, so no one's going to actually get mad at you for saying this, but is Jensen Huang more important than Donald Trump to this market?
I don't think so. I think that what is more important for this market is whether we start to get breadth. So we've had this huge rally that's been driven by the mega caps. And what the consensus, what the street is actually looking for, if you look at the consensus forecasts for things like equal weight S&P relative to market cap weighted S&P, is a bit of a catch-up trade this year. So I think if we end the year higher in equities, it will be because the cyclical outlook has been okay. Whether that's Chair Powell, the macro data, the corporates, or Donald Trump, a combination of all of these things.
We've heard a few times this week is Jensen. haven't we? A couple of times on this program.
Which is bold, because then, there could be a phone call. Excuse me, let me tell you. And, from the White House.
Oh, you think Donald Trump's going to call market strategists and tell them?
He could call Greg.
He could call Greg himself.
He'd be like, really? You think that I'm not the most important guy in the room?
How are you coping with this cold in New York City, Greg?
The cold has been somewhat challenging.
Just two Brits talking about the weather, Bramwell.
Yeah, I like how you
just let it happen.
Okay, go, please go. Carry on.
So I have come armed with the sweater today. I think the windswept avenues in New York are a little challenging.
Would you swap it for the damp cold of the United Kingdom, though?
So I think this is a little bit like the markets, right? We're concerned about both tails here. So we're concerned about inflation and we're concerned about growth. I'm concerned about the UK weather and I'm concerned about New York. So I think, again, we have to be vigilant on the weather front.
Greg Boutle, appreciate it, sir. Well put. Greg Boutle there of BNP Paribas, I think. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Los Angeles is experiencing its worst natural disaster in decades. 5 fires are burning across the city, driven by hurricane-strength winds. At least 5 people were killed and more than 100,000 residents were forced to flee their homes. Major landmarks, including the TCL Chinese Theater and the Dolby Theater, which is the home of the Academy Awards, as well as parts of Hollywood Boulevard, were under an evacuation warning. Federal Reserve Bank of Boston President Susan Collins favors fewer cuts in 2025 due to strong employment data and lingering inflation. Collins expects inflation to decline, but does warn that progress will be bumpy and uneven. Collins is less concerned about the labor market, but will be watching closely for any deterioration, noting that she believes that the U.S. economy is in a good place. Poland's president has asked the government to protect Israeli leader Benjamin Netanyahu from arrest in the country. Netanyahu is speculated to be considering attending the commemoration of the 80th anniversary of the liberation of the Auschwitz death camp later this month. The Israeli premier is subject to an arrest warrant by the International Criminal Court for alleged war crimes in Gaza. That's your brief. John.
Danny, thank you. Appreciate it. Up next on the programme, one big morning call. Craig Moffett of MoffettNathanson with a rare sell rating on Apple. That conversation up next, live from New York. This is Bloomberg. Equities right now, negative by 0.1% on the S&P 500. Almost said 1 hour away from the opening bell. There won't be an opening bell today. Equity futures will close at 9:30 Eastern Time. We've got some trading, though, in the bond market. We'll get an early close at 2 p.m. Eastern Time this afternoon. In the bond market, Treasury's firmer, yields lower. We're down 4 basis points. The 10-year 464.65. Going into payrolls tomorrow morning, the estimate in our survey is 165. We kicked off the trading week by catching up with Priya Misra over the last week over at JP Morgan. Priya made the point, Lisa, that she believes that risks are skewed to the downside for yields and that the possibility of surprising to the upside on things like growth, on inflation, have been diminished somewhat over the past few months.
And certainly that's partly because of the setup that we've seen just with all of the...
Big change.
Right, and the increase in inflation expectations, the increase in also just growth expectations that have been baked into yields. How much is this set for a rally? My question is, if you get a downside number and you do get a bid into the bond market, do you get a commensurate bid or a sell-off in the equity market? That, I think, is going to be a real tell.
Depends how much we miss the median buy.
I know.
It's like 10, 15.
You're running.
Goldilocks downside surprise.
Depends on the
Sub
data. 100.
If
you look at this one.
You think I'm running to be the next Fed chair?
100%, yes.
Okay, all right. Who do I need to get in touch with? Scott? Besson. Treasury.
Please, go ahead.
I said this earlier. No one wants that. Nobody. I'd like to see Bramo in the seat.
Oh, okay.
Are we jacking rates up? I don't know.
I don't know.
Cutting
It depends on the
rates
day.
because things are so bad.
All right, let's move on. Nobody wants that either.
Let's turn to tech. Apple down over 6% since the start of the year as weak iPhone sales and bearish sentiment wound the stock. Craig Moffett of MoffettNathanson is now one of those bears, writing, as great a company as Apple is, the outlook for shares given this challenging backdrop is unfortunately decidedly unattractive. Craig joins us now for more. Craig, welcome to the show. Let's talk about why you believe it is decidedly unattractive. What's that about?
It's mostly about valuation. By the way, I fully think you would have been fantastic for Treasury, by the way. So my 2 cents.
It's an endorsement.
Yeah, that's an endorsement. Look, this is a valuation issue. Apple is a great company. As I said, it is not a broken company. It's a broken valuation. And the point we were making, is as Apple has appreciated, particularly in the last, call it 6 weeks or so of 2024, there was all this commentary about the fact that Apple was sort of melting up with no real news. In fact, there was a lot of news, and it was bad news. You had very negative reviews of Apple Intelligence and lukewarm sales reports coming out of both the U.S. and China for the iPhone. You also had the introduction of retaliatory tariff risk when Donald Trump was elected. Over the time since we had initiated coverage back in August, you had Judge Amit Mehta in the Google case come out and specifically say that the payments that Google makes to Apple for search placement, which, by the way, represent 25% of Apple's operating income, are patently illegal. And in the face of all of that bad news, Apple's stock actually went up instead of down, to the point where the valuation simply wasn't at all attractive. And to frame that, and we can talk about rates in a second, because rates are obviously part of the story as well.
Sure.
But to just frame it relative to the rest of the Mag 7, to which it's typically compared, it's trading at a PEG ratio of about 3. The PEG ratio for the rest of the Mag 7 is about 2. So you've got a really unattractive setup, even relative to a group that I don't think anybody would argue is cheap at the moment.
So let's focus on the valuation. And the question I've got for you, Craig, on the multiple, I think would apply to Tesla as well, but you can answer it with regards to Apple. You've got a company with a high multiple, even though the core business has gone ex-growth or is facing growth headwinds, because there are hopes about what the company could be elsewhere at a time when interest rates are still around 5%. So, Craig, I think this applies to companies beyond just Apple. What are we doing up here, and what is the appropriate multiple for a company like that one?
It's a great question. When we looked at this, goes back now a few months, but when we initiated coverage back in August, we were comparing the upgrade cycle at Apple to the upgrade cycle back in, say, 2021, when they, with the iPhone, the iPhone for 5G, where you had this globally synchronized growth cycle for Apple at the time. And just comparing where rates were then in the wake of COVID versus where rates were in August of this year, and they're now even higher, suggested that you would need about a 30% faster growth rate today in order to justify the same multiple. The growth rate is actually slower now. The multiple is higher. And so you really do have this mismatch between growth expectations and interest rates. Rates are historically low, as you said, but still, relative to most of the past decade, are actually quite high.
So just to build on that, Craig, and your dog is very cute, going forward, there's a real question here about whether just in general, some of the tech behemoths are going to be pressured just by virtue of where rates are, because it challenges just the growth story that you could potentially get.
Well, it's whether it challenges the growth story isn't as much the issue as simply what's the appropriate discount rate to use. And I think the risk-free rate in calculating WACC, your viewers, I think I heard you say earlier, no one's listening today, but your viewers are more sophisticated, I think, in understanding that the risk-free rate as an input to WACC makes a real difference for how you think about multiples. So now the risk-free rate may be higher because growth expectations overall for the economy are higher. But the growth expectations for Apple specifically haven't really kept pace. You have to expect not just a big upgrade cycle for Apple in handsets or potentially some big AI-driven services revenue stream, but for the upgrade cycle specifically, you have to assume that that's a permanent upgrade cycle. That is, that it doesn't just create a big bubble of one-time upgrades for AI, but in fact is a permanently faster growth rate in order to justify the multiple, particularly in the face of higher interest rates.
Is there anything that Apple could announce when it comes to artificial intelligence adaptations or anything that you've heard about them working on that could change your view?
Well, sure. And look, again, I want to be really clear. I am quite positive about Apple's strategy in AI. All the things that are said that are said about Apple and how good their strategy is, that it's capital light, that they have a trust advantage with customers, that they have a unique position for agentic AI because they control the calendar and the contacts and the wallet and what have you. All of that is true. We think Apple is incredibly well positioned for AI. It's just that all of that is already priced into the stock. And so you have to question, well, what is dramatically different beyond that sort of quote unquote story about winning in AI that would justify the valuation? And by the way, we haven't talked about, I mentioned the risk associated with the Google antitrust case, which is very real. Again, a judge saying that the payments are illegal. We haven't talked about China and the challenges that Apple will inevitably face in China, not just because the competition in China is much stronger than it was, whether it's Huawei or whether it's Honor and the handset competition, but also the limitations that AI is almost inevitably going to face in China, because the Chinese government is simply not going to allow Western large language models to answer questions like what happened in Tiananmen Square. So there are going to be all these limitations in China and the potential for regulatory or retaliatory tariffs, all of which says that you have to be sober about the multiple that you apply.
Craig, the dog's not impressed at all. It's good to see you, sir. It's good to see you. I'm finding the pictures of the dog just instantly relaxing, aren't you?
I would agree. Instantly relaxing.
You need a puppy
adorable.
in the studio. We're going to borrow Craig's, all right?
Can you imagine?
Craig Moffett and MoffettNathanson. Clinic there on Apple, by the way. Some real issues, particularly in China, across multiple dimensions.
What's interesting to me is 34 of 49 analysts who cover Apple have buy ratings on it. So this is actually a really out of consensus call.
Super rare.
And to me, it's sort of interesting, especially in light of just the obvious valuation pressures. And, you start to zoom out. Where else is that kind of applicable?
You're seeing it elsewhere, as we mentioned. Up next on the programme, we'll catch up with Jonathan Pingle of Natixis, the most accurate forecaster of payrolls. More accurate than his dad. We'll talk about that in a moment. Theirry Wizman of Macquarie joining us too from New York. This is Bloomberg. Equity futures this morning down by just 0.1% on the S&P 500. Similar move on the Nasdaq. Let's check it out. On the Nasdaq right now, we're down by 0.2. The rust of the small caps just about unchanged and basically unchanged since Election Day in America, which is absolutely phenomenal given the hopes and dreams that we had after Election Day for small caps to start outperforming.
They tried. I'll give them credit. They
had
tried.
a great November.
They had a great November.
Terrible December.
December was not the Christmas that people were looking for. And I guess the key question is how much is dependent on growth and how much is dependent on the bond market that just hasn't given it a break.
US equity markets, of course, closed today, but we can take a look at some of the price action elsewhere with Manus Cranny. Manus joins us now. Hey, Manus.
Jonathan, Lisa, good morning. All dreams of the equity market, they crash into the beach that is called the bond market. And this bond market is drawing breath this morning in the US. It started as a depth charge and the fear over term premium in the United States of America, dissipation in Fed rate cuts. So that depth charge exploded in the US. We paused this morning, 4 basis points lower. Is that the top? Is that a pause from the Fed all priced in? But this is where it washed up in the rest of the world, in Japan, in the United Kingdom. You're looking at rates here that we haven't seen in the UK since 2008 and Japan since 2011. So this is the triage. The triage for this bond eruption from the US and the rest of the world is about fiscal restraint. It's a lesson for the US. Marvin Lowe was with Danny and I this morning, and he said, look, if it's just inflation getting contained, that's the job for central banks. But when it comes to term premium, that's when the casualties show up in the rest of the world. Sterling also under pressure as well. When you have Martin Wheel, an ex-Bank of England governor, talking about, not governor, but on the board, talking about a nightmare from 1976 for the United Kingdom. In other words, a fiscal nightmare of where they had to go to the IMF. They had to borrow $4 $4 billion from the IMF. That's what's being talked about in the UK. So what are the lessons from the triage for the rest of the world for here in the United States of America? This is the risk of one big beautiful bill. What does it cost? What is the price of the one big beautiful bill? Those extended tax cuts and some will materially impact on the fiscal position of the United States of America. And that's when you begin to see 2s, 10s steepen, not from the 50 basis points of where you are at the moment, but potentially to 100 basis points. And that triggers a much bigger global phenomenon. Again, not just triage for the rest of the world, but serious hospitalization. Jonathan, Lisa.
Manners Cranny, honestly, you and Lisa should have a show. Just the two of you talking like that about bond markets.
I don't say hospitalization. I mean, I think that, look, I'm not going to catastrophize.
Tragic.
Yeah.
You're not going to catastrophize.
I never
wow.
do that. Okay, let's move on.
It's an original moment. Investors are waiting December payrolls. They drop tomorrow. A Bloomberg survey of economists showing a median estimate of 165,000 jobs added in the last month of 2024. Jonathan Pingle of Natixis expecting a print of 175,000 and for unemployment to hold steady at 4.2. I'm pleased to say that Jonathan joins us around the table. Jonathan, good morning to you.
Thank you very much, Jonathan.
Have we got the picture in the control room? Because we have to start with the picture in the control room. Jonathan is the #1 forecaster of payrolls on Wall Street. At #2 is his father, Jonathan Pingle of UBS. We did a fantastic write-up of this over the holidays. How did it feel to beat Dad and go back for Christmas and tell him?
It was definitely a positive at the dinner table.
Let's talk about your forecast. What has helped you be as accurate as you have been? What's been the guiding light for you?
I mean, I think the biggest source of explainable variation in payrolls forecasts has certainly been the outsized seasonal distortions post-pandemic. My entire forecast horizon or forecast period of doing this has been post-pandemic, and that's been the largest month-to-month explainers variations. But in general, if I was giving advice for forecasting more broadly, you get most of the gains through disaggregation. Breaking it down by sector, breaking it down into the subsectors, and really trying to figure out the seasonal variations of those.
This comes at a time when a lot of people will take a look at any data point. I'm looking at JOLTS, for example.
Yeah.
And they'll come up with completely opposite interpretations that both seem justified by the data. You could either say it's a great market because job openings increased and actually were much higher than expected. You could say it's a terrible one because the quits rate fell off a map. Which one do you look at? How do you sort of understand conflicting signals like that?
I mean, I think you really have to take it in a pattern, right? If you look at the 3-month moving average of payroll gains, if our forecast turns out to be correct, it'll be down to 146,000. That's coming down from an overall yearly pace of 180,000. And if we look at where we were last year at the same time, it was 212,000. This is a moderating labor market. It's cooling, it's softening or going into softening, and that's not one where you can look at an individual kind of outlier number and really change your whole forecast for that.
Do you have a sense, though, of how fragile it is? I mean, this is something that we keep talking about. This is a frozen market. You're not seeing people being hired. You're not seeing people fired. And everyone's just waiting to see what happens on January 20th. And then all hell will break loose in one way or another. Do you actually see that?
I mean, I heard Greg yesterday call it frozen. I'm not sure that it's completely frozen. I do think that there's still more room for it to cool. We do see the unemployment rate gradually rising over 2025 up to 4.4% at the end of next year. We do think that there is room for payroll pace to slow down. And we do think that, there is real reason that maybe post Q1, there's going to be a lot more discussions on whether the labor market's weakening and a bit more worries there.
You're a student of history as well. How unusual would it be for unemployment to rise as much as it has and then not to have a recession off the back of that?
I mean, I guess you look at the Sommerville indicators and triggering there, it would be quite unusual. But this is a completely different labor market than we've seen before.
What's different about it, Jonathan?
Well, we're at a place right this second where hiring's stalled, quits have stalled, and we're in now a world where businesses are really uncertain and don't really want to take a next step into figuring that part out. And when you're in this kind of world, the movements are really, really slow. And I'm not saying that there needs to be necessarily a tipping point for that to break or one way or another, but for me, keeping with trend and moderating continually seems like the right action.
One aspect of this labor market that's been very confusing to me, and Greg Dacko talked about this before, is historically, as a student of history, the labor market has been a lagging indicator. It is the last one to feel some of the economic cycles. This time, people are looking at it almost as a leading indicator. How do you square that, this idea that this will be the real tell that we're heading towards something negative?
I think it's hard. I mean, I think if you're looking at a Fed that's looking at it as the deciding indicator, right? Like when you have a Fed that puts so much pressure on individual inflation prints and individual payroll prints, unemployment rate prints, it puts us in this state of let's keep looking at this one, be the decider. Is this where this moves? Is this where this is going to change? But in general, I do think you need to take a step back. I think there's a lot of outsized looking at the unemployment rate changes when the statistical significance in these changes is very, very hard. You need a 600,000 employment change to be statistically significant at 90th percentile for unemployment rate. That's like a 30 basis point move, right? Like that's not a normal occurrence. And that's why you need to be looking this in a trend.
There's a lot of skepticism about the accuracy of this data. A lot of people just simply write down 60,000 jobs off the top of every headline number that we get, just simply saying, that's what we're going to find out next year anyway. How do you account for that noise?
I mean, again, it's looking at moving averages a lot of the time. But I do think that this world where revisions to payrolls are giving it a wrong message, it is the most accurate look of where a month-to-month the job market is, right? On a month-to-month basis, the statistical significance of payrolls is like 130,000, right? So it's a lot less. It is going to be the best place we're at. It gets benchmarked to UI claims, and there is a really great revision process to this for the right reasons. And I think you need to keep that in mind. You have these, and you mentally adjust. You look at the last numbers. Everyone's mentally adjusting down by 100,000 for the impact of hurricanes and job strikes, and there is a lot of mental adjustment going on. But with the context, you can start to build this bigger picture of a moderating, cooling, and not all that great, but not all that bad labor market.
Jonathan, appreciate your time. Congratulations on the performance. Just stellar. Thank you, sir. Appreciate it. Jonathan Pingle there of Natixis. Payrolls, of course, dropping tomorrow. The median estimate in our survey is 165. The previous number, 227. Let's cross over to Mike McKee, our economics and policy correspondent, for a whole lot more. Good morning, Mike.
Good morning, John. Well, everybody's going to be watching what the Fed is going to be watching, and that is the unemployment rate, because that's become sort of their lodestar for where they think the employment side of their mandate is going. And we saw that in the minutes yesterday, where they talked about the fact that it doesn't look like the labor market is weakening at all. I wanted to show you this here. A lot of talk about whether or not the Fed is tight, and people on Wall Street say, well, economic conditions are loose, but borrowing costs, look at that. From when the Fed started cutting rates, borrowing costs have barely moved for credit cards, homes, autos, and even the prime rate. So we are still seeing some tightness in the economy, and if they leave it this way, that may help bring down inflation in the future. That's kind of the big deal out there for people right now. Does the Fed move anymore? Given where they have moved, it's going to be a question of whether they think the economy really needs it or not.
Next up, the payrolls report tomorrow morning. Mike McKee, thank you. Just getting confirmation, Lisa, that people are at work. I don't know a single person that's got today off. I don't know a single person in this market has taken today off.
Okay, I'm going to say something. I'm going to get hate mail since there are people watching.
Michael O'Rourke, Jones Trading.
Okay.
I am watching. Excellent conversation with Craig. Thank you.
And Craig was excellent. I will say that. I will just note this. The bond market has it right. The stock market has it wrong. I mean, I think that it's important for us to remember Jimmy Carter. And I'm not saying that. No, I'm not taking that.
Keep digging.
I'm
this
just
is great.
saying let's
this
just
is great
move on.
TV.
All right,
Please,
this is terrible. I'm just saying that I think that just to have, a moment, but I'm not going to rescue myself from this.
No? Okay.
Let's
we don't? All right, let's move on.
Wow.
Bonds? How about those bonds? I'm not sure where you were going. Fireworks in the global bond market in the last 24 hours. The UK 10-year yield hitting its highest level since 2008. The 30-year, the highest since 1998. Investors nervous about inflationary pressures and debt sustainability. A man who's seen it all, Theirry Wizman of Macquarie, joins us now for more. Theirry, it's good to see you.
Morning, Jonathan.
What's behind these big bond market moves, not just in America, but worldwide?
Yeah, let's keep in mind and put the UK's bond move in context here. There's been a rally in bond yields around the world for the last few months, in fact. And I think a lot of it does have to do with the concerns, if you will, about debt sustainability and higher deficits and the inability of some of these governments to bring down their deficits. But of course, this has been also magnified to some extent by the concerns around President Trump assuming power in the U.S. and the tax cuts, presumably that will happen here, or at least the inability to reduce the deficit here as well post the election. So there's been this general theme of higher deficits, more bond supply, This is certainly not the first time in the last few months that the UK is being subjected to these concerns. Keep in mind, there was a mini concern very similar to this one back in October with the budget announcement there. And until we get a situation where these governments are willing to commit to deficit targets that are much lower than the current projections for 2025 and 2026, bonds will unfortunately be under pressure. That is, bond yields will stay high.
Markets change and investor attitudes towards markets can shift as well. And I think a good example of that was the Eurozone debt crisis, when investors began to treat certain bond markets in Europe on the periphery as a credit and not a sovereign. What's happened with the UK? What is the attitude shift? How are we treating UK government bonds?
It's interesting. What's happening today is a little bit different than what was happening in October. If you recall, when Keir Starmer's government came into power post the July election, there was also talk about not committing necessarily to a lower deficit, but actually to more spending. And if you recall, the budget announcement in October that came out of the UK committed the budget to more infrastructure spending. And as a result of this, there was going to be more bond supply. What was different at the time, though, was that, yes, gilt yields rose, just as they have in the last 48 hours. And they rose significantly, but the market was not very concerned about sovereign risk back then. If you look at CDS spreads for the UK back in October, they rose by about maybe 2 basis points. Yes, a move up, but not significant in the grand scheme of the general trend of sovereign spreads for the UK. Over the last 48 hours, this time, however, CDS spreads have risen by about 4 or 5 basis points, twice as much as we saw in October. And I think what this suggests is that the market is transitioning a little bit away from the worries about simply more bond supply to concerns about whether or not the UK in the long term will be able to honor its debt obligations. That's a qualitative difference in what we saw in October. Should it be seen as more worrisome? Yes, absolutely. But in the context of a bond market where everyone all of a sudden, certainly since November, not as early as October, but since November, has become more concerned about these deficits and debt sustainability, maybe this isn't that much of a surprise.
Which really goes to the point of the great British peso that we were hearing about from Jordan Rochester that some people have discussed. I wonder if there's a simpler take, and I'm stealing an idea from John here, the idea of crowding out, and that the U.S. bond market is basically sucking the oxygen out of the room, given the fact that it has risen so much, and yet the U.S. is actually displaying growth in contrast to some of these other economies.
Yeah, there is definitely substitution among sovereign bonds within the bond market. When yields go up in one country, it does tend, and certainly as in a country as large as the U.S., where the bond market is so dominant within the global bond asset class, you do see pressure on yields elsewhere. That makes complete sense. Traders like to chase yields. They like to go where yields are higher. They like to go where the rate of return is highest, sometimes indicated by yield. And if U.S. yields are going up, it's going to put pressure on yields globally. No doubt about it. But at the same time, if we had been seeing a situation where the U.S. was not getting its deficit under control, but Europe and the U.K. were, I certainly don't think that yields in the U.K. and in Europe would have risen by as much as they have over the last few days. This is part of more of a global glut of bonds that the market envisions coming out in 2025 because of these deficits. And it's specific to the U.K. as well, because they had a budget announcement in October that specifically intended to raise the amount at a time when other European countries, France, for example, are trying to get, or at least making sounds as if they are trying to get their budget under control.
This is a historic day, and I want to take a historic approach to what we're looking at right now. Are you seeing an increase in yields as investors demonstrate exhaustion with financing the deficits of economies across the world, and that essentially this is the new regime? And there isn't going to be a free lunch in the same kind of way that there was before. And this is just the beginning. It is not the end.
Yeah. Somewhat ironically, the reason we're seeing this exhaustion is because, at least in some countries, the U.S. being the primary example, growth is actually pretty good. And when growth is pretty good, people feel good about themselves. They want to spend. And as a result, they don't save as much. Now, there may be structural reasons why savings rates are low in the UK and in Europe as well. But keep in mind, if there is a lot of bond issuance, the way to effectively solve that is to have bond buying, right, to keep yields low, to have demand for those bonds. And that can only come from greater national savings. Yes, the government can save more by issuing less, but the public and businesses can buy those bonds if they choose to reduce their own spending. The problem in part is that we have a situation globally where growth is not so good, as to help revenue growth sustain spending at the governmental level, but growth is not so bad either that we should have a flood of savings coming in because of concerns to buy the bonds. We're in that middle range where governments can't seem to draw on enough savings from their domestic economies to have that market clear at a lower yield. The irony, of course, is that if we were to have a global recession, including one in the U.S., and I'm not suggesting we will, bond yields would still go down. Why? Because all of a sudden, the money would fly out of these riskier investments like the stock market. Consumers would stop spending as much as they have. Their savings rates would go up. And all of a sudden, you would have plenty of savings to sustain the bond issuance of these governments. I'm not saying that recession is a solution to this problem.
Terry,
but let's keep in mind that this is one of those things in the outlook that could bring yields down
That's
eventually.
the real test. If we go into a downturn, the deficit's going to gap out. They're going to want to lean in and provide some fiscal support. Will treasuries give them the space to do that? Will they rally or will they sell off?
I think they will rally. If you look at the history of at least recessions in the U.S., I don't claim to have a historical knowledge of every detail of every recession globally, but in the U.S., even though from time to time deficits do expand during U.S. recessions because revenue growth is poor at the federal and governmental level, you typically see yields come down. 9 out of 10 times when there's a recession in the U.S., yields come down, even despite what might be happening in the background at the deficit level.
That is what a developed market sovereign should do. And let's hope that's the case.
That's right.
Next time around. Terry, it's good to see you. Thank you.
Pleasure.
Terry Wizman there of Macquarie. If these issues weren't taking place in the United Kingdom and elsewhere, and we just took the Treasury market in isolation, 425 at the front end, anchored around Fed funds, some steepness in the curve, the 10 years up to about 465. Does it really look like this market's starting to question the debt sustainability of the United States of America? I'd say not yet.
Not yet. And we've heard that from Menace Crenny several times, that this isn't necessarily a bond vigilantes or Liz Truss moment. However, the timing is curious. The fact that we haven't gotten hugely inflationary data or an increase in inflation expectations, that the 40 basis points in December really had to do with something else, and that something else.
That's the point that Torsten Slok of Apollo's made. Yeah, I hear you. Any comments on your earlier comment?
I'll just say this. Yes.
Okay.
First of all, I think it is an important day. I think it is historic. I think it is incredibly important to remember Jimmy Carter. I think that it is not a national holiday. You're looking at me with credulousness. People are in their seats, and we have a moment that Jimmy Carter would want to go on. And so I think a lot of people are betting on this, and I think that that's the reason why. Everyone's at work. It's not a holiday.
This is your correction, that the late president would like the equity market to trade. That's the correction. OK, all right. Let's get an update on stories elsewhere. Let's move on quickly. You had 5-10 minutes to think about that. Let's get to your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The National Weather Service has downgraded its fire forecast for Southern California. The outlook has gone from extremely critical to critical through Friday. 5 fires are burning across Los Angeles, driven by hurricane-strengthened winds. At least 5 people were killed, and more than 100,000 residents were forced to flee their homes. A union representing U.S. dock workers reached a tentative deal with port operators for a new 6-year contract, avoiding a strike. Bloomberg has learned that the agreement guarantees union jobs when certain technologies are implemented. That includes the semi-automated cranes that had been a sticking point. The deal still needs to be ratified by the two sides. Morgan Stanley promoted 173 employees to the top rank of managing director. That's 12% more than last year, but lower than each of the 2 years prior. Major U.S. banks have been bulking up promotions to the top ranks, reflecting their strong performance and expectations for a robust business environment ahead. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead and we'll catch up with Anne-Marie down in Washington, D.C. From New York, this is Bloomberg. Equity futures on the S&P just a little bit softer. We're negative by close to 0.2%. Stability in the bond market. Stability, another word for a rally. We're down by 3 or 4 basis points on a 10-year, 465.26. The trading diary through this week and into next week today. U.S. equity markets closed for a national day of mourning for former President Jimmy Carter. Tomorrow, December payrolls. On Wednesday, looking ahead to next week, the next big data point after that, CPI. And we get some earnings from JP Morgan. That's going to be a big week. Thursday, more bank earnings plus another round of jobless claims. We will have special coverage of President Carter's funeral starting in just a few moments' time. Anne-Marie's going to be leading that coverage for us. AMH, just to get some final thoughts from you on what you're hearing down in Washington in your 24 hours that you've been there and what we can expect through the next several hours.
Well, the next several hours is really going to be about Americans and also past, former, and future presidents gathering at 10 o'clock for the full service for this funeral for the late Jimmy Carter, the 39th president of the United States. And we will be hearing a eulogy from President Biden about Jimmy Carter. And I think something that Americans are really going to take away is how he's going to end the day. He will be transported back, Jimmy Carter, to Plains, Georgia, and there will be a private family ceremony. How he came to Washington, wanting to really take away the pomp and circumstance, and how he has become very popular at 100 years old when he died. For the 44 years he spent after his presidency, working on things like human rights, like global health policy, like making sure there's fair elections around the world. I think that is what Americans are going to take away from today. And I think that's what you'll probably hear from his family and President Biden when they reflect on his life and legacy.
Anne-Marie, thank you. Looking forward to your coverage, AMH, alongside David Gurra in about 5 minutes' time. We'll not be asking you your thoughts on any of that whatsoever.
I think it's very important to have reflection, and this is totally independent. I think that it's actually really important to remember the history and where a lot of the current policies stem from and what happened. I think it's very important to represent and study history.
I'm just winding you up.
I know you are.
Do you want to talk about payrolls?
So. Yes, it's happening tomorrow.
That, please.
Well, I just think that the most interesting thing about tomorrow's payrolls isn't just going to be about payrolls, but the market's reaction to it.
Couldn't agree more.
The idea of, and you talked about this quite a bit, the idea of the bond market potentially seeing a big rally. What does the stock market do with that?
Mohammed Al-Arian wrote in the Financial Times to close out 2024 that the vigilantes were back. Mohammed's joining us tomorrow morning. Do not miss that. He'll join us to co-host the programme from 7 o'clock in the morning to 9 o'clock. So 2 hours with Mohammed Al-Arian. We'll also hear from Chris Ferrone of Strategas. We'll hear from Ellen Zelter of Morgan Stanley, Nadia Lovell of UBS, and a whole lot more. A world-class lineup for you on Payrolls Friday. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.